covered topics like organizational behaviors and motivations and various personality traits with respect to OB. And in HR, we have covered all the basics of HR, which starts from various theories to, I don't recall some of the topics, but the HR is very basics. We have covered all the basics of HR. And marketing also, we have got a very good introduction about how marketing has evolved from the beginning years to now. So that's all has happened in trimester 1.
Yeah, thanks a lot, Sagar. I think it was a great introduction about what you guys have learned. I think most of you can recollect what you have learned in the earlier session, and in particular with accountancy, you mentioned what is journal entry and how do you generalize that particular transaction, and how do you prepare the financial statement. When I say financial statement, I talk about balance sheet, profit and loss account, etc., cash flow statement. You also mentioned about something you touched upon, the ratio analysis. I think that is what the basic the expectation we need for this corporate finance. So let us begin with the corporate finance. So here we want to talk about financial management, and we talk about basic introduction about financial management. We talk about ratios, and we talk about capital budgeting and capital structure, and we talk about leverages, financial leverages, operating leverages, and combined leverage we talk about. And we talk about capital budgeting like NPV, IRR, and other methods. And we also have the dividend policy, and we touch upon what is Modigliani and Miller approach for dividend policy. So this is basically covering that financial management, that is especially the corporate finance aspect actually. So so let us begin. I'll just share the screen.
Professor, so it's under recording, right? Cool.
Yes, it's recording. Yeah.
Thank you.
Who is this?
Shashi.
Oh, Shashi. Yeah, it's recording, Shashi.
Thank you.
No problem. So this is a basic introduction about the financial management, the financial environment. You know that the financial management or the finance team cannot work in a silo. So it has to be a proper coordination between various teams like HR, production team, marketing team, and payroll team. So all the data or inputs we have to get it from the other team, so that we can have a meaningful understanding, meaningful interpretation of the data what we get from other team. So financial management is I mean, people should not think financial management is nothing but you have to prepare the account actually. So accounting team, they prepare the they prepare the accounts. As a finance manager, what you should do, you should interpret the financial statement. You should have a draw the meaningful conclusion about the financial statement. You should see where you stand in terms of financial position, and where your assets are standing, where your liability, and what is your obligation you have to pay, what is the long-term obligation, what is the short-term obligation, what are the source of fund you get, and what is the dividend policy, whether you can declare the dividend or not to declare the dividend. You can recommend the board to declare the dividend. So if it is favorable condition, and you can also recommend the board whether you can go for the particular project. The project team, they submit the project to the finance team, so they have to approve based on various things. They have to see what is that rate of return we get from the particular project, and what is that risk involved in the particular project, and what is the source of finance available to finance this particular project. So all this should be understood, or all this should be interpreted, all this should be assessed by the finance manager. So the role of the finance manager is very critical in case of any organization. So let us see that what is first of all we need to see what is finance. So finance is any activity, any business activity. It involves money. So the money which is required for the business is called finance. So any activity in case of a concern, in case of any organization like sole proprietor concern, or a partnership concern, or a joint stock company, they have various activities. They have various departments like HR, payroll, every department. Each and every department need the finance. So hence we can call it as, finance is a lifeblood business, lifeblood of the business organization. So this is very, very critical. And in terms of any organization, the economic activity is concerned with earning the profit. So we can say that earning profit is major or main objective of any organization, because without any profit, we cannot run the business, because we have to pay day-to-day, expenses, like, you have to pay salary, you have to pay wages, you have to pay rent to the building, and you have to buy the machinery, and etc, etc, etc. For that, you need money. To earn money, you have to have various activity, and to add the activity, you have to get the source of fund. So this is related to the finance management. So some people say that, finance is the art and science of managing money. So financial management is managing money. So how you manage your money, it is a science and art of managing the money. So why I call it as a science? Because you have studied in your earlier semester various ratio analysis. So you interpret various ratio analysis. And you know that, in the liability side, you have various components, like, you have equity, you have preference shares, you have debt, etc. So each and every capital, it has got some component, that is, interest capital or, return capital. So example, preference shares, they need dividend. Example, equity, they expect a dividend. So debentures, they expect they expect interest. So all this will be calculated actually. So you have various methods of calculation of various cost of capital, and we arrive at weighted average cost of capital. So this is a scientific method of evolving the number, evolving the expectation of source of finances. Similarly, when I come to asset side, you have various, you have to project, you have to, finance for various projects. So these projects involve a huge outlay. So because there are various techniques to, evaluate this or assess the various projects. Like, we have NPV, net present value method, we have IRR, internal rate of method, and accounting rate of return method, and payback method, etc. Along with that, we also need to understand the risk involved in that particular project. So to assess the risk, what we do, we have various methods, statistical methods and mathematical methods. Like, we have simulation method, we have simultaneous equation method, other methods. So managing the money, it becomes, it is a scientific approach. We have mathematical formula. So it is, we can call it as, it is a science of managing the money. So when I say art, why it is art actually? Because we have various techniques. So example I gave you, how do you select the project? So you have NPV, you have IRR, you have payback method. So each and every method gives different answers actually. So when you have different answers, then you have to take a judgment. You have to create that, design that which project to select based on various pros and cons. So that is the art of selecting a project. So we can say that finance is the art and science of managing the money. So the financial management includes the financial institution and financial services. So we have various financial institutions like banks, commercial banks, and you have investment banking, etc. And it also deals with various financial instruments. So when I say financial instrument, it covers equity, preference, and you have debentures. You have different types of modern techniques like derivatives. You have options. You have forwards. You have futures, etc. Everything will be covered in financial instrument. So I can say that a finance function is procurement of the fund and the effective utilization in the business. Procurement of the fund, that is the balance sheet item, that is various source of finance, equity, debt, etc. And deployment of the fund, that is in the asset side. So how do you evaluate? You have investment criteria, you have NPV, IRR, payback method. So it is a procurement and proper utilization of the fund. So this becomes finance function. So Khan and Jain is a professor. He defines the finance as the finance is art and science of managing the money. So now we'll come to business finance. So sometimes business finance is also called
Professor, sorry to interrupt. Kumara
sorry.
Here. I don't think we see the slide that you're referring to. We see a PPT with chapter 1, the first slide.
Yeah, that is what I'm talking about.
Okay.
Yeah, I'm just giving the introduction.
Sure, because I thought you were talking about the business organization in slide number 4. Sorry for the interruption.
Sorry, no problem. I'll just... Okay, so I'm just giving the introduction. So then, later on we can go to each chapter, each, slide, and we can discuss. So the business finance, or the corporate finance, is an activity which concerns with acquisition and conversion of capital. So that means how you convert the capital by deploying the capital into various projects, and you can get the revenue to run the business. So this is called finance, business finance. So in a nutshell, we can say that corporate finance is nothing but it's a budgeting, forecasting, cash management, and credit management, investment analysis, and fund procurement. So these are the form of investment management. Sorry, corporate finance. Yeah. So next, here in this chapter, we're covering forms of business organization. We have sole proprietor concern, we have partnership, we have joint stock company, and we have corporate. Joint stock company is nothing but it's a corporate. And we have a very important objective of the finance function, that is profit maximization and wealth maximization. So that we'll discuss about that, and we'll talk about intrinsic value, that is fundamental value of the firm. It depends on the intrinsic value. So we'll determine how do you calculate intrinsic value, and we can also discuss about various markets. We have primary market, we have secondary market, and we have short-term market, we have long-term market, etc. And we also discuss about various financial institutions. So like commercial banks, and you have mutual fund, hedge fund, private equity, etc. So we have discussed about what is corporate finance. Corporate finance deals with budgeting, financial forecasting, cash management, and credit management, investment, working capital management, etc., etc., etc. So here, what happens? So next, we'll talk about various forms of organization. So we have sole proprietor concern. Sole proprietor concern is nothing but it is started by one person, and he is a boss and he is the owner of the company. Someone is unmute? Can you mute actually, please? Hello? Can someone mute yourself, please? Thank you. Yeah. So we have sole proprietor concern, partnership, and corporation. So what is sole proprietor concern? I start a business, and in the name of in my name, Santosh, it is my organization. What is happening? There's no separate legal entity. So what if a firm is suffering from a loss, then it can be recovered from my personal asset. So that is my liability is unlimited. And what happens if something happens to me, or if I want to discontinue the business, I cannot sell this to business to others. So that means I cannot transfer the rights of this business to some other person. So that is one of the features of sole proprietor concern. So partnership is nothing but it's just an extension of sole proprietor concern, wherein you have 2 or 3 people, or more than 2 or 3 people joined together for the common purpose, then they run the business. And whenever the profit arises or loss arises, it will be shared equally, or it is on the agreed basis. Then we have the corporation. The corporation is registered under the statute. So in India, it is Companies Act 2013. It has to be registered, and in different countries, we have different statute. So the corporation has to be registered there. So what happens here? There is a separate legal entity. What the firm is, the entity is different, and the owners are different. So if the company is suffering from a loss, it cannot be recovered from the owners of the company. So they can be called only to the extent of unpaid capital. You have suppose the share capital is 10 rupees. You have paid only 5 rupees. So you can be called only to contribute only to the extent of 5 rupees. You cannot be called to contribute more than 5 rupees. So this is corporation, and this is guided by the Companies Act. So these are the 3 major types of concern. And in partnership, we also have LLP, LLC, limited liability partnership, and limited liability company. So what is the advantages of sole proprietorship? It is easy to form. Anybody can form the sole proprietorship concern, and subject to few regulations. Regulations are not that, we don't have any regulation for sole proprietor. We have partnership. Partnership Act is there in India. For company, you have Companies Act 2013. But however, we don't have any proper act for partnership, proprietorship. So it is sometimes it is guided by Contract Act, Indian Contract Act. And so there's no corporate taxes actually. So what happens, whatever whatever the money or whatever the profit you earn there, that will be taxed in the hands of the individual, not in the hands of the concern actually. So what is the disadvantages? As I mentioned, there's no transferability of interest actually. If I want to stop the business, or if something happens to me, the business cannot be continued. It will come to an end. So with the partner, with the sole proprietor. And I also mentioned about unlimited liability. So what happens in unlimited liability? So whenever the company is incurring, whenever the concern is having a loss, it can be recovered from my private assets. So with the help of we have a sole proprietor concern, we cannot raise the capital. It will be very difficult for raising the capital. So this is one of the disadvantages of sole proprietorship. And so the next step is we have a partnership. So partnership is nothing but it is extension of sole proprietors. So in case of sole proprietor, only one person. In case of partnership, it can be more than one person, and less than Indian partnership says it has to be 20%. Okay, and it is the same. It has got same advantages and disadvantages of sole proprietor concern. And we talked about unlimited liability, where the partnership firm is incurring a loss. It can be incurred or it can be recovered by the partner's private assets. And same thing, if it cannot be transferred to other person. If a partner dies or something, it cannot be carried by his legal heir. So that is the disadvantages of this partnership firm. And coming back to the corporation or joint stock company, it is a legal entity. It has got separate legal entity. That means owners are different. Owners, they'll invest the money and they don't take part in the business of the firm, business of the organization. The business will be vested with the board of directors. So board of directors, managers, they run the business, but they invest the business. So there's a clear-cut demarcation between owners and you have management. That is different. So in India, it is governed by Companies Act 2013. So the main documents which has to be filed for registration of the company is Memorandum of Association and Articles of Association. So these are the two important documents. So it talks about what are the different things, what is the objective of the firm and the company, and what is that different things actually. What is the capital, authorized capital, what is paid up capital, etc., will be discussed in these two documents. That is Articles of Association and Memorandum of Association. So advantages of the company: unlimited life, because it can be transferred actually. The ownership can be transferred. You can go to the stock exchange, you can give your ownership, and it can be bought by other person. So limited liability. The liability of the members or liability of the shareholders are limited to the extent of unpaid capital. If your share is 10 rupees, if you're paid 7 rupees, the company can ask you to contribute 3 rupees. It cannot ask you to contribute more than 10 rupees. And ease of raising capital. So whenever you have a company, it is very easy to raise the capital from the public. It can be through loan, or it can be through loan, or it can go to the IPO. So you can go for the listing and it can get the money from the public. So what is the disadvantages? So disadvantages, we have double taxation. What happens in company? In company, if you see the books of company, you have a taxation. So it is 30%, 40% depending on the statute. So it has to be taxed, and after that you get dividend actually. So then after that you get money from the company. Then that money will be taxed in the hands of individuals. So that will be double taxation actually. And to set up a company is very, very difficult, and it is very difficult and cumbersome. As I mentioned, you have to have minimum number of people at in case of public company. In case of private company should be 2. In case of public company it should be 7. And you have to file articles of association, memorandum of association. We have to file the prospectus, and registration fees. It has to be registered with the Companies Act. So many things are there actually. Form 1 for the Companies Act, it has to be registered in Form 1, and other things actually. Because of this, the cost of setting up of corporation is very high.
Professor, one question.
Yeah, please.
You said for the single proprietorship, you said starting as a proprietorship.
Yeah.
And for partnership, you said starting as a partnership. But for corporation, you said it as becoming a corporation. Does that mean that I can't start a corporation directly? It has to be the other way first and then has to be
No,
converted
no.
as a corporation, or?
No, it is, depending on your, need actually. See, if I told you the advantages actually. See, now, I've got, my own business actually. So I can go, I mean, I don't want to get it filed with, the Companies Act, and, I don't want to share the profits with somebody. That is partnership. So I've got, a very good business. I think, it is depending only on my skill. So I start the partnership. Okay, then I think, okay, I cannot run the business only single-handedly. So what I'll do, I'll take my friends, actually, three or four of my friends, they join the business, then we'll run the business, and we equally contribute that, for the capital. So let's say I contribute 10,000, he contribute 10,000, other person contribute 10,000. The profit also, it will be depending on the partnership rate, we'll share the profit. So that is one, objective actually. Next one, I think, okay, what I'll do, I'll take, I've got, it's a big project, very big project, and I need money from the public actually. So I've got very good name in the company. Example, you have a reputed person, so he wants to start a company. So advantages of starting a company, you can directly go to the public for getting the money. So you have the listing agreement, you have to enter the IPO, then it is that way it happens actually. It's not necessary that the person should be sole proprietor, then partnership, then it is a company. It's not like that. You can directly be a company, you can directly start a company, you can directly start a partnership, or you can start a sole proprietor company. It is depending on the individual objectives.
Sure, thank you.
Yeah, no problem. Okay, so the next, the concept we have is IPO. So what happens in case of IPO? Generally, what happens? We need to have the public company. So we open the public company and we start the company, and it will be registered with the Companies Act, or it will be registered with the registrar. Then after that, we think, we need some kind of a money. So what we do after, we have a listing agreement, it says, the company should be of, number of years, 3 years, 4 years, or 5 years, that is, and the turnover should be blah, blah, blah. So that is, listing agreement says, as per the SEBI, what I do, I go to the stock exchange. Then I say, please list my company, because I want money. So then it will be called as IPO. So my shares will be listed in the public actually. The public will subscribe. Then it will be kind of, it will grow actually. Then what happens after that? It will be secondary market. This IPO normally it will be dealt in the primary market. And once it is listed, or once it is existing, if I need more actually, initially I need money, I go to primary market, I get the money from through IPO process. Then in the subsequent period actually, if I want expansion program, if I have an expansion program, what I can do, I can go to the same stock exchange, not same stock exchange, I can go to secondary market. I can say that, no, look, I'm a existing company. I've got 5 years of track record. I want to go for other one more kind of offer. So then you can get money again. You can get the money. So that will be in the secondary market. So after that, what you can do, you can get the money in the form of equity and debt. So you all know what is equity, right? So the person who has this equity shares, they'll be called as owners of the shares. So they'll get a return in the name of dividend. So whereas debt is nothing but, equity shareholders, they're all owners of the company. So if I buy a shares of Infosys, if I buy a shares of TCS, I'll be the owner of that company to the extent of whatever shares I buy. Then if I buy debt of that company, then I'll not be called as owner, I'll be called as kind of a creditor. So the company, what they say 10% debentures. So what they'll do, every year they give me 10% debenture, 10% rate of interest, whatever investment I do. So in case of that is called interest actually. Here equity, we get dividend. Dividend may or may not be given actually. It depends on the company's policy or company's objective. If they want to retain the money, if they want to utilize this money for future, what they do, they retain the money. Whatever profit they get, they retain entire profit. If they think they can distribute to the shareholders, then they can distribute the dividend to the shareholder. They can have percentage actually. They can have 10% of their earnings. They can distribute to the dividend like that. So this is the difference between debt and equity. So if a company is a public corporation and it is listed, then it can go to debt and equity. So that is what next step actually. So as I mentioned that one of the features or one of the drawback of company, so it has got separate legal entity. So separate legal entity, it creates one barrier for the shareholders and for the managers or for the management people. So I invest money, somebody is looking after the business. So you understand that what is that feeling of the investors. I invest money, somebody will go and run the business. and you don't know what is happening in the business, because you cannot go interfere in day-to-day affairs of the business. What happens every once in a year, what they do, they call for annual general meeting and they present the balance sheet, and they present the financial statement. So that is what but you don't know what is happening. So it is very difficult for an investor, small investor, to say what is happening in the firm, what is happening in the company, and how safe is their money. It is very difficult for the investor to know. So what happens in such case, and there are so many frauds happening because of this. So the management, what they do, they prepare the balance sheet, or they perform the operation in their favor actually. So they neglect the main objective of the shareholder. So in such case, it arises operation and mismanagement. You have something called operation and mismanagement in the Companies Act, wherein they'll be redressed actually. They'll be grieved party. Shareholders will be grieved party. They don't have any say in the company. Everything is kind of decision. Everything is taken care by the board of directors. Because of that, their interest is getting hampered. So in such case, what they can do, they can have a group of people. They can go to the company law board, CLB. They can National Company Appellate Tribunal now. So they can go to National Company Appellate Tribunal. Then they can go there. They can file a case against the company. Then they'll see what is that what is happening with the management. Is it oppressed, or is there kind of undue advantage of this particular position? Everything will be analyzed by them, and they'll be they'll be dismissed the board of directors. The same thing happened in SIFI also. So because of so many years, then they removed the board of directors. Government themselves, they appointed the board of directors to protect the interests of the shareholders. So this happened actually because of various scams happened actually way back in 2000. So many companies they had this the management, they took advantages of this position. They performed the business in their favor actually. They completely ignored the interest of the shareholders. So because of which it was very difficult situation. Then there was a concept called corporate governance. So what is corporate governance? Corporate governance, it says, okay, you are prepared, you are doing the business. Okay, fine. So are you good? I mean, it asks the management, are you taking proper control? What is the control you have? So how you are protecting the interest of the shareholders? How are you protecting the interest of employees? How are you protecting the interest of customers? Everything will be governed by the corporate governance actually. So you have to whenever you have the balance sheet, so they declare actually, the management of the company, they declare, CFO and board of directors, they give the certificate to the shareholder that this is what I've done. I've not taken an undue advantage of the company. So that is what they have to declare actually. So there is something called corporate governance certificate will be given by the management to the shareholders. So if something happens, they'll catch hold of the board of directors, they'll dismiss the board of directors, then the government can appoint a board of directors. So this is what for the investor protection. So this is very, very important tool. So for to check the control in the corporate affairs. So corporate governance is the best, is a set of rules that the control a company's behavior to its directors, managers, employees, shareholders, creditors, customers, competitors, and the community. So we also talk about community, whether they are doing the business according to the interest of the community or interest of the society. They are not doing something some business which is immoral, which is opposed to public. So that is what this particular section talks about. So I talked about agency problem. I think because of this corporate governance, I think most of our agency problem can be resolved. Okay.
This is Satya.
Yes, Satya.
Corporate governance means, can we say it another word, the auditing team or something kind of?
No, auditor will see. Auditor also is part of this, right? See, whenever auditor is also part of auditing. See what happened in Satyam. So our auditors and the management, they have the collusion. They have that understanding between them. So the auditor gave the wrong report. So now corporate governance is also upon the auditor also. Auditor also should look into the corporate governance. Whenever he is doing the audit, he also should require. But the owner's responsibility of the corporate governance is on the management actually. See, auditor is always the third party. Okay. I'm talking about in statutory audit. So there are internal audit actually. So their internal audit is responsible for preparing, taking care of this corporate governance. They have to see what is the control they have and what are the policy they have, what is the policy manual. Everything will be controlled by internal audit. So that is corporate governance.
Okay. Thank you.
Yeah.
Thank you.
Yeah. So, Professor, one question.
Yeah.
Corporate governance is declared internally by the CFO or by the auditors?
No, corporate governance will be, it's a guidelines actually. So it is a separate guidelines, in terms of, if you see Companies Act, example in India, so there are, certain, restriction or certain regulations. So as a manager or as a CFO of a company, I should say I'm abiding by all this, guidelines. Okay.
Oh,
Then
it's
I have
given
to,
by the government.
no, it is not given by the government. So yeah, corporate government cell is a government cell. It gives the guidelines actually. These are the things which the company has to follow. So as a CFO, what I do, I have got a guideline actually. They say that, no, this is a control they have. And if I have any board of directors, board meeting, so I should attend the board meeting. And they also say in the board what happens, if I have any interest in any transaction, suppose, I recommend one person to be, board member. So I have to say that, no, what is the interest I have, everything, transparency. So all this should be, abided by this CFO. And in the
Professor,
annual
does that, one minute, Professor, what do you mean to say? Is it a set of instructions that every employee needs to follow in an organization?
No, it's a corporate.
Professor, I have a thing. That's like, I get it. The thing is when, for example, let's take Apple as a company. It was started, I'm just going through, going all the thing. It's like they started with partnership, then they became organization. Then when they raised fund through IPO, many board of directors come in. Then the managers, like maybe Steve Jobs was just the manager. So what happened is like he had a problem with his board of directors. So it was an agency problem. That was the reason. Because of this corporate governance, they throw him out. Is it correct?
Same thing happened, in case of, Infosys also. That Narayana Murthy, he had, he was an earlier founder. Same thing happened to them. It's not because of that, we'll see that, what is that set of rules and regulations. See, whatever it is, actually, they have to follow the rules and regulations. Example, there should be a transparency in the running the business, and whether accounts, whether the accounts are, kept in proper, and whether the internal controls are in place. Everything should be checked by the, it is the responsibility of the management, or responsibility of the CFO of the company to see everything is going well actually. Then he has to give the assurance to the shareholder that, this company, I am the CFO, and I'm abiding by the corporate governance. These are the things, I have to give the certificate to these shareholders actually. And when I say that, example, if I say I'm being the CFO, if I say I'm following rules and regulation, that means that has to be cascaded to my teams, that has to be cascaded to my employees also, right? Okay, fair, if I fair dealing, example, if you have a fair dealing, and books of accounts are not suppressed, everything. So whatever I have corporate governance, it has to be cascaded to my. See, it's not corporate governance is it's a macro level term actually. So it means transparency. So how do you get the transparency? I have to devise one mechanism. As a CFO, I will devise a mechanism. What is that transparency I'm giving to the shareholders? So I design this. These are the example. In case of purchase, this should be there. In case of sale department, it should be there. In case of payroll, this should be the control. So all these controls I set up. What I'll do, I'll kind of impose this control to the various teams. They have to follow the particular controls and particular guidelines. So,
Professor, I have a question here.
Yes.
Professor, sorry to.
Yes.
My question is, you said that as a CFO, you will try to ensure that there is transparency, right?
Yeah.
So, how does the CFO do it? So, does the CFO have frequent meetings with all the stakeholders and come up with a general guidelines, or how is it? I'm not getting that aspect.
Okay, see what happens, in terms of, he'll not, have a general meeting with, shareholders. What he'll do, that's what I mentioned that, if I want to be transparent, so I should be transparent in each and every transaction which I do in the organization. So each and every transaction, let's say that, in terms of, payroll. So payroll, proper hiring is happening. And if I say proper hiring is happening, and are we kind of recruiting the proper person, and what is his wage, and whether the particular person is competent, everything will be, that is the guidelines actually. So I'm talking about only one department actually. So what I do as a CFO, I give the guidelines to this particular department. These are the controls in place, and the department should follow this guidelines, and they have to have a proper control. Then likewise, I have various teams. I'll be having set up various controls with various teams. Then I, as an internal auditor, I get the report from internal auditor that whether these controls are in place. Then after I'm satisfied that these controls are in place, these things are in place, then I'll kind of assure the shareholder that these are the things happening in my company. So this is what I'm getting. So example, accounting, no accounts, kind of, I am not, kind of missed any accounts, or, no suppressed any books of account, everything is in transparent. So that's what I give the assurance to the shareholders.
So Professor, if I'm going back to my question, that
Yeah.
CFO has the freedom to create a governance or create a model how the corporate governance be in an organization, following the local guidelines of the government, whichever the government recommends in whichever country it is.
See,
And
yeah, please.
Sorry, is that the correct meaning, understanding that CFO will actually declare the corporate governance, how it has to be for a company, and how transparently the information has to be shared to the investors, either by quarterly report or in the annual general meeting?
See, actually what happens, this corporate governance will be decided by the board of directors. Okay, CFO is a representative of this. I mean, suppose, if I say that the chief minister is kind of giving the assurance, that doesn't mean that the state chief minister is giving the assurance. It is the entire cabinet is giving the assurance. So entire board of directors, on behalf of the board of directors, he is also giving the assurance. And likewise, you also give that managing director. If a company has got a managing director, the managing director also should give the corporate governance certificate. So each and everybody who is kind of having that authority, or who is head of the particular organization, they have to give the corporate governance, which is required for the financial statement. Example, we have CFO, and we also get from the managing director. So he also give one certificate.
And Professor, what about when organization is globally, each country might have different governance to be adhered to, right?
I guess it purely depends on the investors, because it is being shared to the investors, right? Investor is from which organization, which country, or representing the which legal entity of the company. For example, if a company is registered in India and investors are in India, then it is only complying with the Indian government policies, and no matter if the company also has a branch in America or China or anywhere. Isn't it correct, Professor?
Yes, I think to partially is correct. What happens, globally we have certain set of guidelines. So globally, you have, let's say that now you have 10 guidelines. It also says that if any guideline is kind of conflicting with your local guidelines, then you have to follow the local guidelines.
Okay, that's like a golden rule. Okay.
Yeah. So that is what. See, I cannot see. If I have organization in America, so I cannot bring that all the kind of policies and whatever they have, I cannot try to match with India. So I have to see which is conflicting in Indian scenario. Then I have to kind of redraft that particular policy.
Does this apply to franchisees as well?
Franchisees, it's not. Is it a different corporate?
No, I think it's the same, but I'm just checking.
So if it is a corporate, that's what I'm telling you. If it is a corporate, which is a company registered in India or in any country, I'm talking about Indian scenario. If a company is registered in India, they have to follow this. So suppose they have so many companies actually. Example, we can think about JP Morgan. So JP Morgan, it is registered in US. So what happens in Indian company? So Indian company is different actually. JP Morgan Chase, which is Indian company. So that company has got board of directors, which should be represented by India, and that company has its own policy, which is global policy, and it is also having the local policy. Then they have to prepare the financial statement. Then they have to have the board of directors approved. Everybody should be in India. All this, that has to be there actually. So if it is a corporate, it has to follow. If it is not a corporate, just a branch or something which is controlled by the head office, then it doesn't have to follow this. If it is a corporate registered in India, then it has to follow this. Okay.
Sure, Professor. Thank you.
Yeah. So the next concept is very, very critical actually. So sometimes this is very much confusing. So the main objective of the financial statement. So the main objective is first is profit maximization and wealth maximization. So when I say profit maximization, we talk about EBIT, or you talk about various devices, EBIT, EBT, various things actually. So that is what we talk about. So here what happens, any business, they want profit to run the business. And this profit maximization is also called as cash per share maximization. And so the ultimate objective of profit maximization is to earn the profit and make good profit and good returns to the investors. So that is the main objective of this concept of profit maximization. And sometimes, there are favorable argument for this profit maximization, because it says, profit should be earned by any company, because, they have to sustain they have to sustain in the business, and they have to meet the regular obligation, like, short-term obligation, or it could be long-term obligation of the company. And sometimes what happens, profit is a parameter actually. So sometimes, we talk about EBITDA of the company, EBITDA of A company, EBITDA of B company. So sometimes what we do, we take this profit as a parameter for, checking the efficiency of checking the performance of the company. And sometimes what happens, there are various risks of the business. So when I say various risks, actually it could be competition, it could be innovation, it could be technology. All this can be kind of addressed when you have good profit. When you don't have profit, it is very difficult to survive in the market, survive in the competition, and we don't have any money for doing further investigation, further research, and be innovative. So that is very, very important actually. And so whenever I say profit is the main source of finance for the company. With the help of profit, you can have various expenses, you can meet obligation, and if you have a very good amount of profit, then you can go to the market and you can get you can raise fund for the company. And see, profit maximization, just we are concentrating only on the profit, nothing else actually. Then there are unfavorable arguments about this profit maximization. So when I say profit maximization, so you all know what is happening. Actually, you have that agency problem. So board is different and owners is different. What happens, in order to show the good performance of the company, they manipulate. Sometimes they manipulate the business and they show higher profit. So that could be very risky actually. Sometimes what happens, to get more profit, what they do, they exploit workers. You have seen, in your many organizations, they exploit the workers, and they also kind of exploit the customer, so to earn the profit. And sometimes what happens, because of the profit, they want to earn good returns actually. So they want to earn good returns, they want to show good performance to the shareholders. They adopt either illegal or immoral business policies. Like you all know that Ponzi scheme. What happens in Ponzi schemes? Right. So you invest 10,000, you invest 1 lakh, and initially you get 25,000 or 35,000. Then next year you get some money. You introduce some person, you get some commission. You introduce some person, you get commission. So that keeps on accumulating actually. So what happens here? Because of profit, people are following illegal or immoral business practices. So sometimes what happens, the profit ignores time value of money. So we're not thinking about future actually. We're not thinking about long-term objective. We think about short-term objective, because we want to earn the profit. By hook or crook, they want to earn the profit. They are showing the profit, and they are ignoring time value of money. They are ignoring the risk actually. So that becomes unfavorable argument for the profit maximization. So next we have wealth maximization. So wealth maximization is a modern approach. So where you don't only, when it says, profit is not only the objective of the organization. Apart from profit, creating the value addition is also one of the important objectives. So that means it is a broad concept. So profit maximization is very, very narrow concept, whereas wealth maximization is a very broad concept. So wherein it gives more provision for improvement, innovation, etc. So if we talk about favorable arguments with wealth maximization, so they say wealth maximization is superior to profit maximization. So we cannot say a business can have profit maximization and wealth maximization both. It cannot be like that. So wealth maximization is a macro, or it is a broader concept. It also involves profit maximization. Say the business say we also need to earn the profit. At the same time, we also need to address so many issues actually, social issues or employee issue or customer issue, or we need to create value addition to the customer. So this is what they say. They talk about value addition plus profit. So that should be the wealth maximization.
Professor, one question. You spoke about cash per share maximization. Can you elaborate on that?
See, cash per share, it is nothing but it is EPS, earning per share. So you have total profit. So the profit divided by number of shareholders. So that is what you need actually. See, you are the business, you are the prospective investor. What you do, you look at the balance sheet and you see what is the EPS of the company. What is the EPS of the company, in the competitor EPS. So you say, let's say that your competitor is giving you 12 rupees and your, the firm you are looking at is giving 10 rupees. So you'll be lured, or you'll be attracted to, do that, attracted to invest in that company. right? Which is giving 12% actually. So apart from this, you also need to see, when I say wealth maximization, apart from, the money or apart from profit, you also need to see what is the track record of the company and how they are good with the customer. Okay, and how they are good with the, that what happened in COVID cases, many organizations, they help or they contributed to the PM relief fund, right? Tata company, they contributed somewhere around 1,500, and Wipro, Infosys, they also contributed actually. So that is what we need to see. So as an investors, we should not see only the profit. We also need to see what is the profit, plus you also need to see what is the value addition it's giving to the society. And you all know that Google, what happened? They're investing some 10 billion, so they're creating employment opportunity in India. So that is very good actually. So that's what we should think about. Yeah.
Professor,
Sure.
hello.
Yeah, please.
Can we also say that profit maximization is it is an objective of short-term sustainability, and wealth maximization is the long-term sustainability?
Yes, true. It's good actually. So profit maximization here is an arrow and it's a short term. Wealth maximization, it could be, it is a long term actually. Though the profit, in the example I gave you, the profit could be low actually for the current year. But if you see that, what is that value addition is giving to the society, so that's what we have to think about.
Okay.
So it's a short term, it's a long term issue. So the primary objective should be the shareholder wealth maximization, which translates maximum fundamental stock price. So stock price is nothing but the price at which the shares are traded in the stock exchange. Should the firm behave ethically? Yes, it has to be. It has to behave ethically. So what happens if they don't do ethically? Because it is not long term. Actually, it's not guarantee that the firm will exist for future period of time. So if they are using wrong means of wrong practice, then definitely something will happen. Actually, then definitely the scam will happen and they'll close the business. Example, you can think about Ponzi scheme. Ponzi scheme, what happens, you get very good rate of return. So first year only people will get, they invest 10,000, they would have got 50,000 rupees. Okay, people are forgetting that, what is happening. I think most of you know what is Ponzi scheme, right? So in Ponzi scheme, what happens? I introduce one person. So I invest in one company, and what I do, I get some kind of a return. Actually, I get 25,000 or something. What I do, I invest. I introduce my neighbor also. Then if I introduce my neighbor, I get 5,000 rupees. Then that guy will introduce somebody. Then I also get the commission. So things will happen like that. But what happens? It cannot sustain in a long term. Actually. So what is that happening? Actually, they should be. You should invest money for something like there should be some kind of product should be there, some kind of a service should be there. So there's no product or there's no service here. There's something they're accumulating the money here. So in such case, what happens? The long-term vision, the long-term sustainability of the company will be impacted. So that we have to consider before you invest in a company. So if you're a normal trader, you want to make money, then do whatever you want. You're a long-term investor. You are thinking that I have to invest today, and after some years I have to get very good rate of return. In such case, you have to see wealth maximization. So we have to give importance to the wealth maximization. If you're a normal trader, then you buy shares today and you sell shares tomorrow. In such case, you can think about only profit. Okay, then we also talk about wealth maximization. Wealth maximization is also included in employment opportunity. So what happens in case of leverage buyouts, LBO firms? What happens? They start the business, and after some period of time, they give the business to the employees of the company. Then the promoters will vanish actually. So in such case, they are encouraging people. Actually, they are creating a value addition for the people. Actually, they are making the employees owner of the company. So that is also one good thing actually. And there are some privatization. What happens in privatization? The government will own owned companies will be privatized or sold to the public, actually sold to the private people. So this becomes privatization. And we also talk.
Question.
Yes, ma'am.
So what I want to know is that does wealth maximization also contribute towards the profit of the company, or is it like two different things wherein profit is focusing only on the expansion and the other aspects of the business, and wealth is focusing only on the
Yes. So as one of our friends
side of the company?
Yeah, one of our friends mentioned that profit maximization is a short term actually, and it talks about profit for the current year. That's it. Whereas wealth maximization talks about various value addition. So how do you create value addition? So you have to create profit. Then only you can do that value addition. If I want to example, I was talking about Google. So if they want to invest in India, 10 billion or whatever the money. So if they want to invest in India, they have to have money first. They have to have their profit. So profit is also there actually. Profit is not the focus area there. In profit maximization, profit is the only focus, and remaining nothing is there actually. In wealth maximization, profit is the focus, but around this we have value addition in terms of shareholders, in terms of you have to create value addition to the shareholders, value addition to the customer, value addition to the employees, and etc. Okay.
So basically, in short, wealth maximization is like a broader perspective of profit.
Yes, it includes profit.
Okay. Thank you.
Yeah. So we talk about the consumer actually. So consumer also should get very good product actually. They also need to get that value addition in the particular product. Then there could be a wealth maximization for the consumer also. Okay, so it says consumer welfare is higher in capitalist free market economy than in consumers or social economies. Fortunately, the most admired firms, in addition to high stock returns, these have high quality from the customer view, employees who like to work in. So that is also very good actually. So nowadays, what is happening, in case of private companies, so they all drive for this actually, wealth maximum. They have to create value addition, because what happens in case of any wrong thing goes to the market, so they definitely it will impact the market. So that's what many of the companies, they have that various redressal cells. Okay, any employees is not happy with the company, they can easily go to the cell, they can discuss their concerns. So many things are there actually. So that is the main objective of this actually. If something happens, this is what employee. So they'll put in that list actually. So this particular company is not employee friendly. So that should not happen for a company. So that's what the company will drive or struggle to get kind of balance everything. So that is the main objective. Okay. The next is functions of finance manager. This is the traditional approach what we are speaking about. So we have forecasting financial requirement. Then he should see that what is the source of how what is the need for money. The finance manager should look into that. And how do we acquire the particular capital? We have various sources of finance. What is the cheapest source of finance? He has to look into that. And investment decision, he has to see the best decision considering the risk and return of the particular project. Then after that, you also need to see the working capital. What do you mean by working capital? The capital which is required for meeting day-to-day affairs of the company. So let's say, for example, I have got various plots actually, in the sense vacant land in India. So I've got various lands actually. I don't have money to survive. So I mean that is what I don't have working capital. So I cannot meet my day-to-day expenses. I cannot pay my telephone bill. I cannot pay my fuel bill. So that becomes very difficult. So a company should have a certain percentage of money in terms of working capital. So that should be there actually. So that is what the finance manager should look into, that every time we have a proper working capital. Working capital is nothing but it is current assets minus current liability. So what is current assets? Current assets, which are the assets which can be kind of converted into cash easily within a short period of time. Example: bills receivable, debtors, stock, bank, etc. And current liability is nothing but the obligation should be met within 1 year. So example, you have creditors, bills payable, and you have outstanding expenses, etc. These should be called as payables. And the finance manager should also interact with various departments. So I mentioned in the earlier, the first discussion, the finance manager should be versatile. He has to kind of connect with various teams like payroll team, so payroll team, marketing team, operation team, etc. He has to kind of maintain a very good relation with other departments also. So importance of financial function, that is finance planning, acquisition of fund. So when I say acquisition of fund, there are various sorts of fund. So you have equity, you have preferences, you have debentures, you have short term, long term, etc. And we have deployment of fund. Deployment of fund, that means we have to select a investment criteria which has got good return, and also we should give due consideration for risk. And it has to be monitored actually. Whenever you deploy the fund, it has to be monitored so that no, you don't deviate from the budgeted one. And increasing the value of the fund and promoting savings. Then the finance manager should also see that no, there are certain amount of money which is saved or which is transferred to reserve capital every year to meet contingencies. And we'll just see the case. I mean, most of you were discussing about social responsibility, or you were talking about wealth maximization. We'll just see these two cases, Ben Jerry and Levi. Are you able to see the screen?
Yes, sir.
Just a second. Just a second. Are you able to see my screen?
No.
Sir, we're not.
No, Professor.
Sorry. Are you able to see the screen now? Fundamentals of financial management.
Yes, sir.
Yeah. So here we have a very good case actually. So Ben and Jerry. So
Professor,
Sorry?
I think I see a folder, not the PDF file. So
You're not able to see the PDF file, Ben and.
No, we see a
BRC
folder.
folder.
Okay. Sorry.
You're
Just
able
give
to
me
see the file name.
Are you able to see this?
Yeah. Yes, now we can see it.
Yes,
Thank you.
now.
Yeah. So this is a nice case. Actually, what happened in Ben and Jerry? So Ben and Jerry is a US-based company which was formed in 1970s. So it is basically it is a manufacturer of yogurt, ice cream, etc. So what happened? This company, we can see that what is ups and downs it has got throughout its journey actually. So this is a very good example for wealth maximization. So let us see here. See here, the company founder, Ben Cohen and Jerry. So what they did, they started the business in vacant land. That is, in vacant Vermont gas station with a capital of, $12,000. So then what happened, after that, they were running the business and, etc. So what happened, they made sure they buy the particular milk from the local actually. So buying the milk from the local was little expensive because it is not standardized. So what they used to do, they used to buy the milk from the local vendors, giving the opportunity for the local people. So they used to buy from there, and it was supposed to be more expensive. And that is what you can also think about. What is that they are doing for the suppliers. And at that time, what used to happen, it used to contribute 7.5% of their earnings to the charity. So you can see that now what they were doing. Initially, they were, kind of buying the material from the local, which is very expensive compared to buying from outsiders. Then second one, it is, it used to give 7.5% of their income for the charity. And the third one, it says they were about, 750 employees in the company, and they used to give 3 pints of ice cream every day, yogurt. 3 pints of ice cream every day for the employees. So that means here they're also taking care of the employees, they're also taking care of the local suppliers, they're also taking care of the charity, social cause. So that's what this particular company. So what happened? So somebody mentioned that this is. See, a business cannot be a charitable institution. So you can think about these. If you overdo it, you have to balance it actually. So if you overdo it, what will happen? You may not have the profit. So you have to create certain portion of your profit to contribute for this social causes. Then what happened? Because of then. Hello. Sorry, can you mute yourself, please? Hello. Yeah, thank you. So what happened? Because of this strategy. Yeah, because of this strategy, what happened? The company could not earn very good amount of money, because of which it entered huge losses. And at that time, what happened? In 1995, the company was offered to sell its Japanese company. They wanted to take over this business actually. So that time, what happened? This particular company said, I don't want to sell this company, because at that time, 1995, it was Japanese market was like a China market. Most of the products were not that good quality. So this particular Ben and Jerry company, they said, I don't want to sell my business to the firm where they don't have proper reputation. So that is what I'm telling you. That day it has got very good. They offer very good sum of money for this deal. But these people, they said, I don't want to sell this company. So that is what I'm telling you. So you should not. That is what they are sticking to their kind of ethics, business ethics. So they want to do something which is creating value addition or creating employment opportunity to the people, and it is creating some charity, and the product should be liked by all actually. So because it's a dairy product, so if you give a inferior quality, it may kind of endanger people actually. So people may become sick, and it will be it causes issues. So that is what they didn't want to enter this kind of a business. They said, I don't want to enter the business. Then what happened? Because of this, this particular CFO got down, and other person came into that. He is running the business. So this is a kind of in nutshell. And I want to say that the corporate, this responsibility of the company, it is they are sticking on to their norms. They're not diverting into this. So this is one of the examples. And if you see other example of Levi's. Yeah, so you all know that this is a brand actually, Levi's store. So what happened? This is a 150-year company. This is very famous for jeans pant. So what happens? They said they want to stick to their social activism. So they said they want to stick to the social activism, and this is very important paragraph actually. If you see here, yeah, if you see here, so they always teach people that how to enter the transaction, which is legal, or which is sorry. Okay, so they were integrity. So they were always talking about the team integrity, team teamwork and team integrity. So that's what they employed the same thing to the people actually. They said they had a 10-day workshop for the people. They said how you should run the business, how you should you should do a legal business. That's what they were promoting to the their employees. Then what happened? Because of this, they got very good names in the society, and they got very good vision also. In 1998, it had earned 1.1 billion. So that was a huge profit. That was a huge turnover for the company. Then later on, what happened? Because of they were too much into social activism. Because of which their profit deteriorated. Because of the profit deteriorated, and they had so many ups and downs actually. But still, we can say that as a finance manager, still we can say this is a good this thing, because they have profit, but at the same time they're also taking care of other needs actually. They are also creating value addition, because I can say that as of now, I'm talking about 1998. So it had very bad kind of this thing. After 98, it had a very bad phase. During the phase, people could economists and financial expert, they used to say that people the management can run actually, because it has got very good brand. So that is what is very important actually. So it has created a very good brand. So because of the brand, it can earn profit in the future. It's not that currently it may be not earning the profit, but because of the brand, because of the social reach out, it will definitely earn the profit. So that is what the moral of the story. Okay. So these two examples, indicate that, the company should not only concentrate only on this, they also need to concentrate on other aspects also. So you're able to see the slides, no? Again, we are coming back to the slide, our slides.
Yes.
Yeah. So now you understood that now what is profit maximization and what is wealth maximization. So I can say that we have seen the two examples. I can say that wealth maximization is balancing between your profit and value addition to the various parties like shareholders, employees, society, etc. So that has to be there. It should be a balance. So we have studied with the case. Okay, so now there should be three cash flows actually. So free cash flows, CFF. That means so the cash which is after everything, immediate expectation. So that is called free cash flow. So the cash flow should be expected actually. So that means there are three kind of an expectation from the investors. That means we should get the expected rate of return. That means it can be big actually. It can be big, and it says the timing of cash flow should be important. So the better the sooner we get, that it is a better actually. So you invest in a company, it will not, it will give after 5 years or 6 years, it will start to give the returns. Then that will not make any sense actually. So it should start giving the return, and the risk of cash flows that also should be considered. So you first year you give very good rate of return, you give 25%. Next year you give only 2%. Next year you don't give anything. So that will cause issue for the investment's value. That means that will not create any wealth maximization to the shareholders. So we should always take into account for the investor's perspective. So it is expected cash flow. That is what I look actually. So I need kind of every time I need at least 20% rate of return. So that is what I need. Then I also need every year I should get 20% rate of return. Not only the 20%, it could be 18, 17, 16, depending on the business actually. Okay, that I need actually. Timing of this one and risk of involved in the cash flows. So that should be less actually. So every year I should get actually 1 year I should get 30%, 1 year 2%. That is not expected. So that is not that will not create any value to the shareholders. That is not wealth maximization. So free cash flows are the cash flows that are available for the distribution to all the investors. So free cash flows is nothing but sales minus operating cost minus taxes minus required investments in the operating capital. Okay, so now we can discuss about intrinsic value of the firm. So what is intrinsic value of the firm? Intrinsic value of the firm is nothing but I discussed about future cash flows, that is free cash flows divided by 1 plus weighted average cost of capital. So what is weighted average cost of capital? So let's assume that in our balance sheet you have debentures, you have equity, you have preference shares. So what is the weighted average for preference shares can be 10%, equity it depends on the dividend, and debenture can be 20%. So what we do the weighted average cost of capital that we discuss in the coming classes. So what we do, we combine all the we combine or we take average or we take weighted average of all the cost of capital and we create this formula actually. So that is your free flow of cash flow divided by 1 plus weighted average cost of capital for 1 year plus second year plus third year, it goes on actually. So this becomes intrinsic value of the firm. So here I've explained. So sales minus operating cost and operating losses will be your free cash flows. So with the free cash flows, what do you do? Free cash flow divided by 1 plus weighted average cost of capital. What is weighted average cost of capital? Cost of debt and cost of equity. So you do the weighted average for that, and you have to create take it for the power of 1, take it to the power of 2, it goes on actually. So this is intrinsic value of the firm. So the next one is capital allocation process. So here what is happening, here you have direct transfer actually. What you do, you go to the market or you go to the particular company, you buy the shares. So that's what, shareholders. Yeah. So here what is happening, the shareholders, they go to the company, they buy the shares. So that is direct transfer, and transfer through investment bank. So what is happening here? The investment bank, they these people, they go to the bank. These people, they invest, they take the money and go to investment bank. The investment bank will go to the company, so they get security and they give the security to the, it's like a broker actually. Okay, so through the broker also you can get the shares of the company, you can invest in the company. And there are other financial intermediary example. You can think about mutual fund. What happens in mutual fund? It will get money from the public. It will pool the money from the small investors, and it will invest in the various shares of the company. So what happens? The shares, tax savers will give the money to the financial intermediary. In turn, what they do? They invest in the business. These people, they get securities. Example, they may own Infosys shares or TCS shares, they may own, and they give their security to us actually. Like example, mutual fund units, they give it to unit holders. So this is how the capital allocation process happens.
Professor, sorry to interrupt.
Yes, ma'am.
Can you please go back, not this slide, the previous one?
Yeah.
Yeah. Please explain. That was a bit fast.
Sorry.
Can you
see what happens, you have the sales actually, sales for the organization, sales minus operating cost. So what do you mean by operating cost? So operating cost is something, but you have fixed cost, you have variable cost, etc. You minus all the cost, and you also minus your taxes. So, and after that, you have some certain portion which is required for your operating required for interest charges, other things actually. You get deduct taxes, and you deduct your interest charges, other things from that particular portion. So that becomes your free cash flow. Okay, so free cash flow divided by 1 plus weighted average cost of capital. So what do you mean by weighted average cost of capital? You have cost of debt, you have cost of equity. Okay, so you have various means of calculation of cost of equity. So you have growth model, you have price earning model, etc. You calculate for equity, you also calculate for debenture. Okay, let's say equity you get 10%, debenture you get 20%. So what you have to do, we have to calculate weighted average cost of this capital. So 20 plus this divided by number of shares also. So that is what we have to create weighted average cost of capital. Then what we have to do for, if I say that if I want to see intrinsic value for 5 years, it will become free cash flow 1 divided by 1 plus weighted average cost of capital. That is 1 plus, it could be, let's say that weighted average cost of capital is, if it is equity is 20, sorry, debt is 20 and equity is 10. So your weighted average cost of capital could be 0.3. What I do, let's say that this is 10,000 divided by 1 plus 0.3 to the power of 1. Second year, free cash flow, that is 10,000 divided by 1 plus weighted average cost of capital, it is 0.3 to the power of 2 plus free cash flow, that is 10,000 divided by 1 plus 0.3, because weighted average cost of capital, what we calculated here is 0.3. So we have to calculate for 5 years. Then you get intrinsic value of the firm for 5 years. Am I clear?
Thank you, Professor.
So this is just illustration, we'll do the problems and other things, we do in the forthcoming classes. Just, I want to say what is intrinsic value. Normally, intrinsic value is attached to your wealth maximization. That's okay. And here we are not talking only about the profit here. We are also talking about risk, or we are also talking about various expectations from the source of the fund. So that is what we also talk about. When I say wealth maximization, we can also talk about intrinsic value of the firm. Okay, the next, we have financial security. We have two types of market. One is money market and one is capital market. So money market is a market which is for a short term actually. It could be for below 3 months. And capital market is more than 1 year, 2 years, more than 1 year, and up to 10 years can be a capital market. So there are three types of securities. That's what I mean: equity, debt, and derivative. So equity, you have money market, is T-bill actually. So T-bill is it is given by the bank for 3 months, and it is collateral, or it is gilt edged. If something if it is defaulted, the government is backed by the security. Okay, the company is giving the security for this kind of a small bill actually. So you have certificate of deposit. So normally that is given by to meet the short-term obligation. Then we'll discuss about this. And we also have euro dollar and we have federal funds. And if you come to debt, we have T bonds. What is the difference between T bonds and T bills? T bills is for short term and T bonds is for long term. It is more than a year. And we have agency bond and municipal bonds. It is normally in US. We have municipal bonds. And we have corporate bond. Corporate bonds are those bonds which have fixed rate of income. And in equity, we have two types actually. We have we don't have anything for money market, so everything is long term only for equity. One is capital market, one is one is common stock, one is preferred stock that we have discussed. And in derivative, we have options, futures, and forwards. So So what is option? So option is a contract where it gives the right for the buyer to buy or sell the contract. So option is a contract which offers buyer or seller to buy or sell the particular contract. So depending on the type of the contract, they hold on the underlying asset. So derivative is nothing but, so the value of the derivative is a contract. The value is derived by the underlying security, underlying asset actually. Underlying asset can be commodity, it can be index, anything actually. Anything you can have a derivative. You can say if rain is coming, that can be underlying asset actually. If the rain comes, it's not like a betting, but it all depends on the performance of the market. Okay, options, you have two types of many types of options. You have call options and put options that we'll discuss actually. I'm just giving you the brief about this. We'll discuss in length actually. Then you have future contract. Future contract and forward contract is almost similar, but future contract, what happens in future contract? It is all traded in the stock exchange. So it is all standardized contract. So it is all legal agreement. And whereas forward contract is a customized agreement. So what happens in future? So future contract is a legal agreement to buy or sell a particular commodity, asset, or a security at a predetermined price at a predetermined time in the future. So what happens? I enter a contract with Kumaradatta. So Mr. Kumaradatta, I say that I want to buy the share. I want to buy this particular product, or I'll say that you just got a harvest actually, wheat. So I want to buy this harvest after let's say 6 months. After 6 months, I want to buy this particular harvest for a predetermined price. I say per kg, I'll pay you 10 rupees or 12 rupees. So then it becomes a particular future. I mean, if it becomes a contract actually. So if it is OTC and I was talking about the commodity transaction, so that will be dealt in forward contract. And if it is a stock exchange contract, it is based on the index and other things, it will be a future contract. So these are the things which we can discuss actually when we have source of finance. We'll discuss. I'm just giving you a heads up for this. We have options, we have futures, we have forwards. So forwards and futures is almost similar, but the thing is you have the same thing. It's a contract, and to buy or sell the particular commodity or asset at the predetermined price at a predetermined time in the future. Same thing, but this is more standardized. This is not standardized. So this is OTC and this is exchange traded contract. So this is a glimpse of various financial institutions. We have commercial bank, we have investment bank, we have various mutual fund, mutual saving banks. We have life insurance company, we have mutual fund, and we have pension fund, we have hedge fund, and private equity. So I think we are all familiar with all the concepts, but I'll just touch upon mutual fund. So what is mutual fund? Mutual fund is a pooling of small investment by the small investors and investing in the diversified portfolio. So what happens, I am a small investor, I cannot invest in a big company. I cannot invest in TCS because I've got very small money. If I invest in the company, after that the market falls, my entire money will be lost. I'm scared actually. I don't have a knowledge of the market. So what I do, I go to mutual fund, I buy some mutual fund units from the mutual fund. So what happens, they collect money from people like me and they invest in big, investment actually. So they have various objectives actually. I mean, I have to see that what is the objective of this fund. Some funds they have objective of investing in the real estate fund. So real estate fund, that if you think real estate funds are doing well, you can invest there and you get very good money. And some funds they invest in emerging market countries. So if you think emerging market countries are doing well, you can invest in those funds. And if the emerging markets are doing well, you get good money. And some funds, they invest only in equity. Some funds invest only in the preferred, and some funds they invest in fund of fund. Some other fund, some other mutual fund, they invest in some other mutual fund. So for this kind of services, mutual fund charges a fees. Actually, we have to pay the fees and we have to enter the transaction because we are using their expertise. They are kind of giving the professional advices to us. We have to pay for that. So that becomes kind of I mean, see, if you have a very good knowledge about the industry or knowledge about the market, you can go and invest. If you think you don't have a proper knowledge and somebody kind of does the work, you can invest in the mutual fund and they charge some professional fees that will be called as management fees, and they'll be charging that one. So hedge fund is also almost similar. So mutual fund in India, it is it is governed by SEBI, Security Exchange Board of India, and in US it is governed by SEC, Security Exchange Commission. So in each and every country, there will be separate statute which will govern this mutual fund, because you are dealing with mutual fund is not dealing with their money; they are dealing with investors' money. So because I invest in one of the mutual fund, ICICI Lombard, ICICI Prudential, they're not dealing with their money; they are dealing with investors' money. So we need to have the protection. So SEBI has given certain guidelines that they have to have so many things. There are so many guidelines, there are so many regulations. They have to follow that. So that is very restrictive. Actually, they cannot invest wherever they want, however they want. They cannot invest. Whereas in hedge fund, it is almost similar to mutual fund. They will not pull the money from small investors. It will pull the money from high net worth individual. So because for them high net worth individual, what is the concept for them? They can earn money, or they don't want to bother about money. Actually, that is what they're think. But if a small investor, they invest, they need money for their various things. Actually, various for the retirement and education. They need for various things. So that is what very important actually. So hedge fund, what happens? They can invest wherever. See, example, I am high net worth individual. So high net worth individual is defined in different contexts, in different laws, defines in different way actually. So example, according to Indian law, if I say that I am a high net worth individual, then what happens? These mutual fund will, I have to invest 1 crore, or I have to invest 5 lakhs, 10 lakhs, whatever I have to invest in that company. What happens? They invest in high and risky areas actually. Wherever they think, the mutual hedge funds, they think, you can get a very good rate of return. They take high risk and they invest actually. Sometimes what happens, if the entity is not doing well, I may lose my 5 lakhs or 10 lakhs, whatever I invested. Then if entity is doing well, I may get 20 lakhs or 30 lakhs, whatever it is. It depends on, market condition. So high risk and high return for hedge fund. So there's no restriction actually. There's no restriction by SEBI. There are very limited restriction, but like formation, other things. But in case of investment strategy, they don't have any restriction. So normally what happens? Hedge funds, they invest in derivatives. Derivatives very risky. They invest in derivatives. But in case of mutual fund, most of the mutual fund, they invest in equity. Some portion will be invested in derivatives, not all the portion. But because it's a risky, they have to protect investors, fund. Otherwise, hedge fund, they haphazardly, they aggressively invest in the market. Wherever they get an opportunity, they invest. They get a very good return. Sometimes we may lose the interest also. So private equity is just like a startup, and it's like a joint venture. So they start up the company, and for that, they give the finance. So suppose I'm starting, I have got a very good skill. I've got very good skill of conducting the classes or something like that. So what happens? I got that idea. I approach bank. I go to the bank. I say that okay, look, I'm interested in this. I don't have money, but I've got very good expertise. So can you fund me? So what happens? They fund for the particular venture actually. So what happens? They also expect some kind of a return actually. See, it's a normal loan. They say that give me the loan is given for 10% or 15%, whatever it is. In this case, they also check, or they also ask certain portion of profit. So we give the profit, and after some time they also go away. Then this particular private fund will be listed and it become a company. So that is what a brief introduction about this financial institution. So we have seen.
I have one question.
Yes, ma'am.
So where does the government investments come? Like we have our FDs, or we have debentures, or we have post office investments. On that, in sometimes we get like good interest rates. So how do those investments or those government plans come under? Like under what do they come?
Okay, this is a very good question actually. So the ma'am's question was, you invest in PF. Let's say PF is very good example. So what is the rate of interest for PF? How much you get the rate of what is the rate? What is the interest rate you get in PF?
I think
8%.
somewhere 7.5 or something.
7.58 something.
No, 7.25. I mean, let's say that for example, 7.25 was there when the market was very good. See, if you, I mean, I'm talking about the situation where PF
Now it
rate
is
of
6.25.
yes, that's what I'm telling you. They invest in very safe securities. Okay, so I mean, example, this PF fund. I mean, example, if you think about mutual fund. I mean, now, I mean, I'm talking about not now. Actually, I'm talking about those days. When economy was doing well. So people used to get at least 15 to 20% of rate of interest. Okay, whereas PF they were getting only 7.5%, 8% rate of interest, only because they do not invest in risky securities. They invest in very secure securities. Example, I was talking about treasury bill. Okay, treasury bill, if want, I mean, it's a security which is given by the government actually. So what happens, example, PF fund, they invest in government securities. Okay, they invest in government company, they give the security, they buy the security. If something happens to the particular fund, particular security, what happens? It is collateralized with some government asset actually. So if that, suppose I invest in PF, the PF will invest in some government security. So that government security will go for a toss. The company is not doing well, something will go for a toss. Then they get the collateralized. They convert the collateral amount and they get the money. So you don't have any issue for the money. So that is what the rate of interest is very low actually compared to other one. So you think about fixed deposit. Fixed deposit hardly it's giving 4% or 3% now. Very less actually. If you think about other way of investment, it's it's giving 8% or 9%. But what happens in fixed deposit? Fixed deposit, something happens to that money. So the government is giving the guarantee that they'll give the money. The RBI is giving the guarantee because they have to maintain certain money with the RBI. Right, the bank should give maintain certain portion of money with RBI. If something happens to them, so that will be utilized actually. So you have guarantee for the money. So because of that, you have very less rate of interest. So as ma'am's question, so you invest in a government company. Where do the government invest? Where do the various funds like pension fund, PF fund invest? They invest more in government fund and very less in equity and risky security. Very less actually. The majority portion will be on very safe securities, because of which we get very less return. Okay, ma'am.
Yeah, and so one more question. I want to understand about the Bitcoin. Like nowadays, it's too much into the market. Like everyone's like investing in Bitcoin is good. So how does that work, and how is it different from the normal share market that we have?
See, the Bitcoin is it is a it's a cryptocurrency actually. So it doesn't have it will not be dealt in any stock exchange. So it is over the counter, it will be dealt actually. So what happens in Bitcoin, the risk is very high. Okay, you invest in that Bitcoin and that particular price may go to it may fall also. So that is a big risk we have in Bitcoin. Okay, so that is what we encourage people not to invest in Bitcoin, because if they have very good knowledge and other things, they can invest, or if they have very surplus of fund, they can invest, because it's a high risk and high return. Whereas if you invest in stock exchange, it is low risk, and I mean it is not low risk. If you invest in equity, it will be having a low risk actually, and you get moderate return. Okay.
Thank you, sir.
Yeah, no problem. So we have discussed about money market and capital market. We discussed about physical asset and financial asset. Physical asset, we have property, plant and equipment. We have other things, and financial assets we have equity, preferred, debentures, etc. And we have spot versus future market, that also we considered. Spot market is today's price, and future market is for contract for the future period of time. And we have money market and capital market. So money market is for short term, and capital market is for the long term. and primary market and secondary market. Primary market is for the initial IPO. Initial, if you want to raise the capital for the if you are if you want to raise initial capital, then you can go for primary market. Already you are kind of listed company and already you are raised the capital. Then you can go to the secondary market. So primary market is new issue. And what happens, issuer receives the proceed from the sale. So what happens, example, you buy shares, example, IPO company. If I want to list my company, list my shares, what I do, I go to the public and ask them to invest in money. So whatever money they invest, I get it directly from them. But whereas in secondary market is, whatever you buy shares of, Infosys today. So you're not buying the shares. That means, the 10,000 will not go to Infosys. It is just a trading actually. So it is just within the stock exchange, that the price is traded actually. It's not, you're not actually buying actually the security. So here it says issuing firm doesn't receive proceeds and is not directly involved. So Infosys is not directly involved in that. It could be, any other stock exchange, could be Bombay Stock Exchange or National Stock Exchange. They trade this particular security. So you buy the security for 10,000. The 10,000 rupees will not go to Infosys. The 10,000 will go to the stocking market. It is a traded amount actually. Trading, it will go to the trading. Okay. Clear with this, guys?
Yes. Yes.
Yeah. Yeah. Can we have a break for 5 minutes, and we can start with the new one?
Sure.
So,
sure.
Yeah. We left 10 minutes break, Professor.
You want 10 minutes break for me or for you? Okay. Yeah.
No, for everybody.
Okay. No problem, sir. So we'll come back at 11:15. Is that fine with everybody?
Yeah.
Okay. Thank you. Can we begin?
Sure, Professor.
Yeah, thank you. Yeah. In the first session, we discussed about what is financial statement, so what is finance function, and what is the role of the finance manager. Now, we'll discuss what is that exactly he does with the financial, statement actually. So when we say financial, this chapter session talks about the financial statement and financial statement analysis. So when I say financial statement, it talks about various aspects. It is, income statement, and we talk about, position statement. So position statement is nothing but it's a balance sheet, and income statement is nothing but it's a profit and loss account. So apart from this, we also talk about, various things actually. So these are the information actually. So these are the information which is prepared by the accounting team. So accounting team, what they do, they prepare the financial statement, they prepare, balance sheet, they prepare profit and loss account, they prepare cash flow statement. As a finance manager, we should derive the meaningful information from this actually. We have to do the interpretation of this particular financial statement. So this helps, to take the proper decision, and this also helps, to see the corrective actions to be taken for the management if something is going wrong. So I discussed about income statement, and we also talk about balance sheet. We also talk about cash flow statement. So income statement is nothing but it's a P&L account. So what are the components you see in the P&L account? So for profit and loss account, it will have, it will have opening stock, it will have, closing stock, it will have sales, it will have purchases, it will have administrative expenses, it will have gross profit, it will have, various expenses like, interest expenses, salary, wages, etc. And it will also have the tax position or tax payment actually. So what is the balance sheet? It talks about the position of the particular asset as on today. Actually, if I say 31st March 2030, what is the position of the asset? So how much I need to kind of pay to the lender actually? How much I need to pay to the investors? How much I need to get from the various debtors, various bills receivable, and what is the stock position I have? What is the current assets I have in my balance sheet? So that is a two equal different term actually. So balance sheet and profit and loss account should be different actually. So whenever we say profit and loss account, we cover a period actually. They say from 1st January 2020 to 31st January 2020. So it is covering 12 months. So whereas in balance sheet, it say as on that day. So as on 31st March 2020, what is the position of the particular asset? Okay, that's what we see. In income statement, it talks about the performance of the company. As I said, from January till December, we prepare the profit and loss account. That means it says what is the performance of the company from January till December. So all these 12 months, what is that operation? What is that profit? What is the sale? Blah blah blah. It will talk about that. What is the performance of the company for the last 12 months? And when I say balance sheet talks about as on that day, what is the position of the particular asset? That means as on today, what is the value of the building? As on today, what is that value of debtors, creditors? So that's what it says for financial position of the company, and it says financial performance of the company. And we also prepare the cash flow statement, and we'll discuss what is cash flow statement. So cash flow statement, it talks about what is the source of fund which we got, and what is the application of that particular fund, because everybody is interested actually what is that money we got into the business, and what is the money, how did you expend that money. And cash flow statement will have various things like operation activity, investing activity, finance activity. So that is what the shareholder wanted to know actually. So in financial statement, there are various users of the financial statement. So who are the users of the financial statement? Primarily, it will be it will be used by the shareholders. The second, the government also will look into the financial statement, and creditors and debenture holders and employees, they also look into the financial statement. So all these parties are interested in knowing the financial position and performance of the company. So that is what the main purpose of this financial statement. So whenever we get the financial statement, it is the duty or it is a responsibility of the finance manager to evaluate or to draw the conclusion. See, example, how do you analyze actually? You have 20,000, you have sales 20,000, and we also think last year what was the sale. So last year sale was 10,000. This year it is 20,000. So that means it is good actually. It's, companies having good sales, and what is the turnover, and etc. etc. We can see that the finance manager can interpret actually this financial statement. So again, we are having the same intrinsic value of free cash flow. You have revenue. Out of revenue, you minus all the cost and taxes, and you minus example interest rate and dividend, etc. You minus from there, then it becomes free cash flow. Free cash flow, it is used to calculate the intrinsic value of the firm. What is intrinsic value of the firm? Free cash flow divided by 1 plus weighted average cost of capital. So what is weighted average cost of capital? It depends on equity, it depends on debentures. So if the debenture is 10%, that's what I give the example. If the debenture is 10% and equity is 10%, debenture is 20%, equity is 10%, then it becomes 30%. In mathematically it is 0.03. So then we can think about cash flow 10,000 divided by whatever it is. You can keep on multiplying, depending on the number of years. And this free cash flow will change every year. Okay, so this year you may get sales, X number, and next year you may get sales Y number, and this year you may get different numbers. So calculate that amount, and you have to divide by weighted average cost of capital. So weighted average cost of capital, that means you have to weighted average all the cost of capital like equity, debentures, preference, everything, and you have to bucket it into one weighted average cost of capital. Then it has to be divided by that, 1 plus that number. So you have to take it for all the years. So that is intrinsic value. Okay. Next, next we talk about financial techniques of financial statement analysis. So the financial statement analysis is interpreted mainly to determine the financials and operational performance of the company. So this is what the main purpose of the company. And there are various methods actually. There are various methods like ratio analysis, comparative statement and comparative statement. We have trend analysis. We have common stock statement. We have fund flow, cash flow, etc. So we'll discuss one by one. So comparative statement, that's what I mentioned that we compare different period actually. We compare the data from a different period. Example, you have sales. You have sales this year is 20,000. Last year it is 15,000. So that means we say that it is increased by 5,000. So we also need to expect that other things will also change actually. So when the sale is increasing, your data also should increase, or your data in the balance sheet also should increase by 5%. Are you getting the point? Hello?
Yes, sir, we got it.
Yeah. So see, I'm talking about balance sheet, and we have a linkage between your balance sheet and your profit and loss account. So example, we have sales. Sales is linked to the data. When the sale is increasing, even the data also should increase. That is what the expectation, right? If the sale is increasing by 10%, the data also should expect to increase by 8 to 10%, something like that. And if the creditor is increasing, and that will impact your purchases actually. And etc. And example, if the plant and machinery is increasing, and your depreciation for the particular plant and machinery should also increase actually. So we have that link between your balance sheet and your profit and loss account. So that is what keeping in mind. If anything is kind of changing, we have to see that corresponding change in your P&L account. Okay. So if let's say that if sale is increasing, so the sale will have impact on many things actually. The first of all, it will have impact on your balance sheet. That is on the data side. If the sale is increasing, we also see what is the ratio it is increasing in the debtors, and it will also increase your stock actually, because you buy more stock for producing the product. That also will increase. And sometimes what happens, the sale will be impacted by cash sale as well as your credit sale. So that also will impact actually. So the cash also we tend to expect more. If the sale is increasing, we also need to see the turnover. Okay, that turnover by how many percentage is increasing. So if the sale is increasing by 20%, then if the turnover is increasing only by 10%, then we have to see that there are some other expenditure compared to last year. It is incurring actually, because of which it is not going in that direction. So that is what we draw the conclusion from this particular financial statement analysis. So this is the first technique actually what we use in comparative statement. What we do, we take the balance sheet for the current year, and we take the balance sheet for balance sheet as well as your P&L account for the current year, and we also take for the corresponding year, or we take n number of year, 1, 2, 3, whatever years we take, and we try to compare and we try to interpret. So that is very important for this comparative statement. And the next one is trend analysis. So what we do, we get the data. So what we do, we create a trend with the data and we try to interpret. Example, you have a sale actually. Every month you have 1,000, 1,200, 3,000, something like that. And during the month of, let us assume that the company is chocolate company. So during the month of December, we expect that it is double in the sale actually. So you draw that actually every year. January you have this much sales, February you have this much sale. So it is almost more or less the same. January 1,200, February it is 1,300. It's 100 something. It is almost similar. But if you see December, it is coming to 8,000. So what could be the reason? We have to understand what could be the reason. So if it is a chocolate company, this is mainly because of Christmas season. So Christmas season, more chocolates actually. So that is what we have to interpret. So if it is very down actually, let's say that every month on an average you sell 1,200. In one of the particular month it's only let's say 500. So we have to understand why it is only 500, because it could be exam season or something like that where people they don't buy chocolates. So that is what we have to understand with the trend analysis. So in trend analysis, what we do, we get a series of information. We try to arrange in a series of information and we try to see how the trend is going, how the movement is going. It could be upward direction and it could be a downward direction also. So depending on that, we have to understand how the movement is happening. Depending on that, we have to interpret the data. So similarly, we can also think about debtors. So every year, debtors, it is some amount actually. Every year 5,000, and 1 year it is only suddenly it is 20,000. So that means you also need to expect that 20,000 means that trend is only 5,000 on an average. One particular year is it is very significant amount. That means we have to understand what is that special in that year. So it could be some kind of special order we got for the chocolates, something like that we have to understand. So the next one is common size statement. So what we do, we have the balance sheet, we have the P&L account. What we do, example in the balance sheet, we take some common factor. We take some common factor and we try to see what is the percentage of that common factor to others. In case of balance sheet, what we'll do, we'll take sale. Sale is sale, we take it as a base actually. So that will be 100%. Then in the balance sheet we take asset, total asset, we take it as 100, and we'll see what is the percentage of that in cash, what is the percentage of that in loan, what is the percentage of that in receivable, what is the percentage of that in cash. Everything we just try to minimize that amount. We try to simplify that amount into very small numbers and we try to interpret the data. We commonize actually. So in case of profit and loss account, what we do, we take sale, or we take turnover, or we take sale as a base actually. We take that as 100, and from that we analyze actually. From that example, you have expenses actually. So you say sale is 100%, and some expenses something actually they have some amount. So we have to divide that amount by sale. So you get some percentage. So we have to compare. So that is called common statement analysis. So we have an example. I'll show you the example for this. So are you okay with comparative statement and trend analysis and common size statement? So comparative statement, we have two data for 2 years. We compare the data and we do the interpretation. And trend analysis, you have the series of information and we see that what is the movement of in each variables or in each series. Then we try to interpret.
Sir, I have a question.
Yes, yes, please.
When we talk about the trend analysis, do the analysis on the sales completed figure, or considering the hot list or the forecasted figure or a pipeline what we have in our list?
See, okay, this is a very good example. So how do you forecast the sale? So if I say that your name, sir?
Satyanarayana.
Satyanarayana. So I say that now you prepare the sale forecast for next 12 months. How do you base that now?
Based on the market study.
Based on the market study, but
factor. The second factor is considering the last year trend.
Yes, yes, yes. You said trend. So what we do, we consider what is the last year trend actually. So that's what I mean. Made an example January you have so much, February you have so much, March, April, May, and one particular month is very low actually because there's no buyers for the particular chocolate. Maybe that is a season where people they don't buy chocolates. And in the month of December, it is very high because it's a Christmas season. I'm talking about chocolate company. So December you have a significant amount of sale. So what we do, we you have some data, the trend you have. So based on the trend, you also see that okay, because last year it's fine. This year we've done some advertisement. Okay, we have done some marketing, good marketing. So we expect 10% of increase in that amount. Or whatever it is, last year is only last year same month. If it is 1,000, we expect 10% to increase actually. Then that means 1,100. So your forecast will say you expect 10% because of you have done a very good advertisement, very good marketing, and the wrapper of the particular chocolate is changed, and you are giving some good goodies to the people, something like that. You expect some movement actually. Because of that, you forecast. So to forecast that, you need some kind of a trend. So that is what it is driven from this trend analysis. Okay. Satyanarayana? Hello?
Yes.
Okay. Okay. So the next one is common size statement. In common size statement, what we do, we take some element as a common, and we take it from there. Actually, example, if it is an asset balance sheet, you take the asset. So you make asset as 100, and you try to see what is the percentage of that particular item to the particular asset. And in case of profit and loss account, what we do, we take sale as base. So if the sale is 100, and what is that expense? What is the percentage? And what is the expenses? What is depreciation percentage? What is salary percentage? Etc. 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 We derive from the common size statement.
Sir, what is the industry use for this common size statement? Like what analysis will come out of this comparison? Or
see, I'll tell you one thing. Common size statement. We don't use. It is not that useful now. It was very old traditional method, and we don't use actually. And this could be the input for ratio analysis.
Okay.
I mentioned about example. You take sale. And you also take up. We also talk about expenses. So what is that expense ratio? What is that expense to sales ratio? So that is what we are deriving. So it is become little redundant, not very much popular actually. Common size statement. So common size statement is kind of a giving input for the ratio analysis. So we are doing ratio analysis in each and every step. We are doing that. I can show you that one. So it is not having that significance in modern era. Okay. Yeah, and next we have fund flow statement and cash flow statement. So both almost it is similar actually. Fund flow, cash flow, both are similar, but fund flow is very broad concept. So it also consists of cash and cash flow. But cash flow in cash flow statement, you are determining the cash flow. You have opening cash and you have closing cash. Then you determine that. And we in the fund flow we see the movement of fund. For, how you get the fund and how it is utilized in the organization. So normally we are talking about working capital. Working capital is consisting of various current assets minus current liability. So what is current asset? You have bills receivable, you have debtors, you have stock, you have cash. And what is current liability? You have bills payable, you have provisions, you have trade creditors, etc. So we see that whether we are in a very good position to meet day-to-day activities of the business. So that is what we need to see from the fund flow statement. Okay, and in fund flow, what we do, we prepare the schedule of changes in the working capital. Okay, we prepare that, and in cash flow statement, we don't do that. That is already taken in the operating activity. So when I come back to cash flow statement is more important for me. See, because anybody asked actually if investor wanted to know, they wanted to know not the fund wise, they want to know what is the cash, because cash is very significant amount, very risky. When I say cash and cash equivalent, so it is a very risky actually. So anybody wants to know how much you earn the cash, okay, and how much cash you're expending, and what is the cash you have at the year end. So what is that movement? So that is what they wanted to know. So this is very, very important from the investor's perspective. So now what has happened, fund flow, it is only for the costing purpose, cost management and cost accounting. So that is not having that relevance now. And the cash flow has become one of the part and parcel of your financial statement. So they have to, because in EAS says that it has to be given. In EAS says complete financial statement includes your cash flow statement. And US GAAP also talks about cash flow statement, and IFRS, International Financial Reporting System, it also talks about cash flow statement, giving the more importance to the cash flow statement. So investors wanted to know. So because they don't want to know the entire transaction, throughout the year they don't want to know. They want to know you have received so much of money, and this is the profit you have, and what is that ultimate balance you have. You show me the reconciliation, and you bucket this transaction into 3 buckets actually. One is investing activity, operating activity, one is finance activity. You bucket actually. Then depending on that, I'll see actually whether investing activity is more, or what is that, whether you're getting outflow or inflow from investing activity, or inflow or outflow from operating activity. That is what decision making I have to do. So in fund flow, I don't get that I cannot do that analysis. So both are almost similar, but the objective is different actually. It is more macro level fund flow, but this is very much macro level fund flow statement. So that is very important. These have become a part and parcel of your financial statement.
Hi, sir.
Yeah.
So actually, when we are analyzing any performance of a company, we are seeing various financial statement which is available over the net as well. So profit and loss is available, balance sheet is available, cash flow statement is also available. But I have never seen a fund flow statement as such.
So, that's what I'm telling you. Fund flow doesn't have any significance. That's what I mentioned. Because you would have seen cash flow statement, because various accounting standards says cash flow statement should be a part of your financial statement. Fund flow statement is only to know actually working capital. So working capital is consists of your various current assets and current liability. So this is mainly required for the manufacturing entity. That too for the costing purpose, not for accounting or financial management purpose. We don't use it.
Is it hidden for the shareholders, and is it available only for the within the company?
Actually, I used to do the audit of the company, but normally fund flow is not required for them actually, because because I'm giving the audit opinion on the financial statement. So they say the financial statement includes your cash flow statement. See, as a shareholders, I want to know how you got the money. 1 rupee you got, how you got 1 rupee, and how you're spending 1 rupee. That's what I want to know.
That we can analyze from EPS, PE ratio, and further things like.
No, you can think only about the performance of the company. I'm not getting that how you got the money, how you spend the money. So that I'm not getting from the fund flow statement. That I'm not getting from EPS. The balance sheet I don't get actually. So when you do the interpretation of the financial statement, then you can prepare the cash flow statement. It is not that easy to prepare. You have to see that what is that working capital, whether there's an increase or decrease, or etc. etc. Then it gives as a shareholder, I have to know where more of the fund is invested, whether investing activity or finance activity. So let's say that operating activity. So operating activity consists of various day-to-day operations, like you sell the goods, you you pay the current assets, current liability. All this will be in your operating activity. Investing activity is nothing but you acquire plant and machinery. Okay, you acquire various plant and machinery, you sell plant and machinery. So as a shareholder, I want to know whether my money is investing in proper allocation of money. And investing activity, finance activity consists of borrowing of loan from the bank, and raising of additional capital, and repayment of any loan, and payment of interest, payment of debentures, payment of dividends. All this will be your finance activity. So as a if I see the cash flow statement, I have to get the interpretation that okay, my objective of the business is this and this, and whether by investing in such activity is it justifiable. Okay, so that we have to see. Example, my entity is it is a manufacturing entity. Okay, I know that now I'm investing in manufacturing entity, and if I see the cash flow statement, more of money is gone to your finance activity. So why this so actually? Why you have to go? Why you have to go? More of finance activity. So like if it is a manufacturing concern, you have to have various projects. Like you need to have investment in particular asset. Your plant and machinery should go up, or your building, or purchase of land, purchase of building, etc. So that is why this that's what I have to get. It should trigger in my mind. So if the firm is having more of finance activity, that also means that it also need to have the same impact in your investing activity also. Because how do you finance? If I want to purchase any asset, how do I finance that one? I have to get it from the shareholders, right? I have to raise additional capital, or I have to get additional loan. So that is what I have to create, linkage between various activities in the cash flow statement. So this kind of analysis cannot be done in your fund flow statements. So fund flow, it says, what is the working capital and what is that, you have what is the opening working capital and what is the closing working capital. So that's it has. So it is not having any significance for the shareholders to know. Okay, so this will be prepared. It's not that it become redundant, but it is prepared in the cost, costing team actually, cost management team, not by the financial accounting team. Okay, so now it is becoming more significant for them, not for us actually. For us, it's only the cash flow statement.
So, sir, in that case, is it like, suppose I'm investing in Infosys. So, Infosys will also invest in another company so that they keep, like having a proper flow of their profits or of their money, or it is entirely dependent on how the company functions in that fiscal year.
See, normally, if you invest in Infosys, actually, it is not expected from them to invest in other company. Okay, if they have surplus money, they can invest. It's not that they cannot invest. They can also invest because of your articles of association says they can also invest in company. But I cannot have majority of the investment in others company. See, Infosys, they are into software business, right? So I expect more investment on projects, not more of finance activity. Correct. If I go to banks, if I go to investment bank, so what is the main activity of investment bank? I expect them to have this activity more of finance activity. That means they have to invest in other companies. But they invest. It's not that I'm not denying that they don't invest. They invest, but it's a very little small portion because they have surplus money. Instead of having in the bank, what they do, they invest in other company. So that they can get.
We have companies like Deloitte or Ernst & Young and PwC. These are like core finance companies.
Sorry, I didn't get you.
So, like we have core finance companies also, like Deloitte and EY, PwC. So, how does it go about for companies like these?
See, Deloitte, EY, and all, they're not finance companies. So they are all advisory companies. So they are all financial services actually. So they, example, Deloitte, EY, and other things, they do statutory audit. That is the service they are giving, and they do internal audit. They give advisory services actually. They don't do anything on that. They don't buy stock on behalf of the client, and they don't do the trading actually. But if you think about JP Morgan, so JP Morgan, what they do, if it is custodian, okay, JP Morgan custodian, what they do, they create. I mean, they maintain the books of accounts. Okay, if JP Morgan is investment manager. So what they do, they give advice to the example I was talking about mutual fund. So mutual fund should have investment manager, and it also need to have investment manager. It also need to have custodian, and it also need to have fund accounting. It also need to have various parties. I'm just giving an example of investment manager. So investment manager, what he does, he'll go to that example, ICICI Lombard. So he consult ICICI Lombard and he'll say that look, you have to invest in A security, B security. Now the market is not doing well. Please withdraw the money or invest in the particular security. That will be advised by the investment manager. So he'll get a professional fees for investment fees actually. Okay, investment manager fees. And what we have a segregation of duties. We have fund accounting. What fund accounting does? They prepare only accounts actually. They don't give any advice. So decision is taken by the investment manager. Okay, investment manager, he takes a decision and he'll say, okay, buy the share. Then he'll give the instruction to the fund accounting and say that okay, I bought the share, please pass an entry. We have just passing entry. They pass an entry and they prepare the financial statement.
Okay, so it's nothing to do with this fund is good or maybe investing it. It's nothing like that. It's just that the part, like the function of the financial service companies, like they just have your entire statements or entire transactions for the year that are put into the specific accounts, and then at the end of the year they tell you that, hey, you know what, this is what is your profit or this is what is your loss.
Okay, I was talking about an investment manager. So investment manager is also financial services. So it's not only preparation of accounts. Preparation of accounts is fund admin job. So what I'm talking about is entire financial services includes fund accounting, and it also gives it also includes investment manager job also. So you can also guide team actually. But in EY and all, they're not in investment manager. They are into financial advisory team actually. So they have actually, they can also advise a team, but they're into different role actually. So they can, I mean, because they have a statutory audit and they have they cannot do the advice to the company actually. In the sense, they can have, through the channel, they can also see what is that, statement of operation, what is that, whether there are control in place, and whether how you can make your control efficient, and other things they can advise actually. They can advise.
Okay.
Okay, and there are two things actually in other, in Big Four, they have, channel 1 and channel 2. Channel 1 is nothing but they are doing the statutory audit. They are giving the opinion on the financial statement. Channel 2 is advisory services.
Okay.
Okay, if I'm doing a channel 1 example, if I'm auditing Infosys, I cannot give any suggestions to the Infosys.
Okay.
Okay, because if I give any instruction or if I give any suggestion, then I'm not giving any independent opinion. So auditors should always give independent opinion. So if I'm doing channel 1, that is first type of work, then I cannot give any suggestion. If I'm doing second type of work, I can give the suggestion. I can see what is the control you have, and whether the control is proper, is it commensurating with your size of the business, that I can give advice. Otherwise, I cannot give any advice.
Okay.
Okay, so financial services include your investment manager, and it also include your fund accounting. It also include custodian, transfer agent, blah blah blah. It includes.
Okay.
Okay, probably what we can do, we can look into a few problems now, and we have some examples actually. I'll just look into the example, then we can come back to ratio analysis. So I'll just quickly touch upon what are the things we discussed in techniques. We discussed about comparative statement, and we talked about trend analysis. We talked about common size statement, and we talked about fund flow statement and cash flow statement. I think we'll look into a few examples, then it will be easy for us. So are you able to see my Excel sheet?
Yes, sir.
Yes, sir. Yes, sir.
Yeah. So this is one example of balance sheet of one banking company, and so I'm giving an example for comparative statement. So this is a banking company. You have capital and you have reserves and surplus, and capital could be I think it is only equity capital, and you have deposits. So deposits, you have borrowings, and deposits is I think we can assume that it is with statutory compliance. So like example, they have to keep some certain portion of money with Reserve Bank, something like that. So this cannot be a working capital. The deposit cannot be a working capital for this situation. And you have the borrowings, and you have liabilities. So if you go to the asset side of the balance sheet, it says cash and bank balance with RBI, and bank balance with RBI. That is, bank balance with other bank actually. So they are investing in RBI. They're also investing in other bank actually. That is, money at call and short notice. That is a very short period. You can get the money back. Demand deposit, something like that. So you also have the investment. So bank also can do the investment, and you also have the advances. Advances, nothing but you are given for the customer. You are given for the customers, so that they take into account as advances. And you have fixed deposits. You have fixed assets. That is plant and etc. And you have other assets. Okay, other asset could be anything actually. You can have payable, receivable, salary payable, something like that. So this is the balance sheet of the bank. Okay, so don't worry about the numbers here. So this is one typical example of how do you take the balance sheet. So what I did, so I have divided this into various parts actually. So as per the Companies Act 2013, it says the balance sheet should be you should have current assets, current liability, current assets and non-current assets, current liability and non-current liability. So that should be the bifurcation of your balance sheet. So what I have done, I've just taken the same figure here actually. So first, current assets. Current assets is only two here actually. It is only cash, and it is only the money at call and short notice with other banks. So that is only current assets. So that is definitely. I mean, this is just I defined actually for this example. And if you see other assets, that is fixed assets, you have investment. investment, and you have advances. Advances nothing but the customer, bank customer, they have taken loan from you actually. So that is not, they may pay after 1 year term loan. It could be term loan or it could be term deposits. So that is coming in the asset side. You have fixed assets and other assets. So all these are comprising your current asset. All these are comprising your current liability. Okay. And when I go to current liability, it is only borrowings and others. This only called borrowings and other liability is forming your current liability. Okay, so here you have deposit. So you can think about deposit from the customer. They make fixed deposits, recurring deposit. They say that after 2 years or after 10 years I'll withdraw the money. So this becomes your deposits. The deposits is not current assets. So I'll mark here what could be the current asset. So this is not current asset. I'll say non-current liability. And this also reserves and surplus also non-current liability. And deposits, it is non-current liability because it's not a current liability. It's non-current because it is not. I mean, you have to pay after 1 year or something. It's not immediately you have to pay that amount. So this is non-current liability. So borrowings is nothing but borrowings taken by the customer. It could be short-term borrowing. So short-term borrowing could be for 1 year, 1 month, 2 months, things like that. So this will become current liability. So other liabilities and provisions, that becomes your current liability. So when I come to asset side, so cash and bank balances with RBI. So this is current assets. So this becomes current assets for me. So investment. So this is non-current assets. So advances also non-current assets. Fixed assets is non-current because fixed asset cannot be realized into cash immediately. Then other assets, I'll take it as non-current only for this example. So what I have done, I have divided into this theme actually. So I say this is what, and I say this is increase and this is what is the percentage of increase or decrease. Example, we'll take about the cash. In 2004, it has become 22 lakhs. Earlier it was only 27 lakhs. So that means there's a decrease in the capital, decrease in the asset actually. So if there is any decrease in the asset, actually it's not a good sign actually. So we need to investigate what is this for actually. Then if you think about 11 lakhs and money at call and short notice, it says 11 lakhs and it has increased to 16 lakhs. That's a good sign actually. So 41% is increased. And if I see the investment part, I say almost 9% is increased. That is good sign actually, because whatever money we are getting from the business, we are investing in this business. That is also good. And customer loan, it is coming as 7.6, okay. And financial asset is coming as 8.9. And other assets is come down actually to 1.9. Maybe I don't know what is other asset. It could be for other current assets like receivable, short-term receivable, something like that. So it is come down. So it is come down. That is fine actually. For me, it's not a big issue because it's only insignificant amount. It's only 21,000. That is fine. It is only 1.1 million. Sorry, 1.1%. And total fixed asset is 8.48. So it is increased actually. Total fixed asset is increased and total current liability is increased by 5%. See what is happening here. It is increased. Here you have okay. So here it is only increased by 5%. So we need to understand why current asset is increased only for 5% and why current asset fixed asset is increased by 8%. So this is the interpretation I have. So 8% and 5%. We should understand what it is. And when I go to the borrowing, so borrowing is decreased actually, decreased to the extent of 60%. So that means borrowing, that means that is a main source of income for us. When people are taking money from, I mean the bank should run the business from people taking the advances from that. So it is decreased to the great extent actually, 60.88. That means people who are getting the borrowings from the bank, it decreased to the extent of 60.88%. So this is the alarming factor for me. What is that happening for this? Why it is decreased so much? So this is, we have to see why it is decreased so much. Then other liability is fine actually because it's very small amount. That is fine. And current liability is decreased. That is fine. Then if I go to capital, last year and this year comparatively, it is only 20% increase because we have, we have to see that maybe if you see that this is zero actually. capital is 0 because it's all fixed actually. And profit is increased to the extent of 20.1%, that is this year. And deposit, it is increased to the extent of 7%, and this also increased actually. So we have to understand what is that issue actually, then we have to interpret from this statement. So this is the, we don't have the complete information about the banking, so we cannot, draw the conclusion. So we have that in, some amount, but we cannot draw the conclusion because we don't have full complete information about the bank. So when you get the complete information about the bank, and as somebody mentioned that they have the financial statement, and you have that, what is the objective of the company and what is the other things, what is a new contract, etc., new project, then you can interpret this data very easily. Because for the finance manager, that is what I told you, there should be interrelation between various teams or various other departments. So if you have a proper relation with other teams, you get to know what is that happening in this particular balance sheet. You will understand that. So I have taken an example of only the balance sheet. So similarly, we have to do the same thing for your profit and loss account. So this is just an illustrative example. So that is what this is how we do comparative statement. So you take 2 years, or sometimes you may also have 3 years, and we also need to draw for 3 years also. It depends. Clear with this?
Yeah.
Yeah. Thank you. So somebody was asking me about the trend analysis. Okay. So if I see the trend analysis, see for the bank, you have deposit and advances is the main source of the business. You get the deposit, and people will have the fixed deposit in your bank, and you give the advance to the customer actually. So that is what the main business. So balance sheet, what is that? It should be there actually. We'll say that So this is the deposit. So what happens? People will deposit in our bank. So this is what 40. So this this particular number of 4 crore 40 lakhs for 42,000. It is indicating that so much of money we have to pay to the borrowers actually. So what happens? They have kept some kind of a deposit with the bank. So here, if you go that it is advances. Advances means people have taken from us actually. We have given advances, short-term advances, or it could be kind of a overdraft or something like that. So this is our balance sheet. So if I go here, so these two are important activities for the bank: deposits and advances. So you also get the profit. So I mean, just this is an illustration. I'm taking the example of deposit. I'm taking example of advances. I'm drawing the profit in that. So if you see here, it is starting from 99, 2000, 2001, 2002, 2003, 2004. So what I have done, I have taken this 99 as a base, and I've seen the movement actually from here to here. What is the movement? So example, if I say this as a base, 266. Sorry, 266, 45, 251 divided by 205, 51, 498. So I put in percentage. Sorry, this is not. Okay, so this is coming to I mean, you forget that this number, you take this number. So this is coming to 129.6. So it is increased by 29.6. If you compare this base, this it is increased by 29.6. Likewise, I have drawn that conclusion actually. Likewise, I have drawn for 10% for advances, 10% for profit also. So example, this 406. 287 divided by, this is the base, 350 is the base for me, this 100, 350, 311. So it is coming to 406, 287. Okay, it is coming to, see, you can see that in the next year it is coming to 115.79. So this is what I have created the trend actually. So if you look at each trend, it is 100%, 100%, 100%. In 2000, if you see, it is 129%, 129%. It is almost the profit is same actually, 115 actually, maybe because there could be some other expenses actually. If you see in 2001, it is 155, 163. So almost it's in the same trend actually. So to set the trend, you should also see that what is the percentage of you can accept actually. Then you can also see that it is 214, 217, and 230. So you can see that now from this example, all the three variables is going in the same direction. deposit is going in the same direction, advance is also going in the same direction year to year, and profit is also going in the same direction. So it's all going in the same direction. So we can draw the conclusion that the trend analysis is working fine for this elements, whatever we have taken, deposit, advances, and profit, it is working fine. Okay. So next one is common size statement. So that is what I mentioned. So here what I've done, I've taken the same example of banking company, the same sheet I copied here.
Sir, I didn't get how you are concluding that trend analysis is fine. I'm not able to get it.
See, trend analysis, what I'm doing, I'm seeing from year on year. See here in this, that's what I'm telling, we cannot conclude everything because we don't have the data, complete data of the particular bank. So what is happening? See, that's what I told you. Deposit, advances are the main kind of activities we have in the bank, right? So deposit and advances. So we'll see the deposit is increasing by in the year 2000. Deposit is increasing by 129%, and the same advance is also increasing by 129%.
Right.
And if I see that 2002, 181%. This is also almost 182%. It's also same actually. It is fine. So and even the profit also it's almost it is same actually. Maybe this year is 150 because you may have some additional expenditure. That's
where I had a confusion, because in some places profit was a little higher and some it's not that much when compared to the previous year. That's why I was asking.
Yeah. So I mean, for me, these two are working fine, and we also need to investigate. See, because these two are how you example you go to the bank and take the loan. How will they give the loan for you?
Based on the salary and what kind of asset.
Yes. What is the source for them to have the loan actually? How will the bank will give the loan for you? So this is because your credential. I'm talking about bank. Where will they get the money?
Based on deposits.
From reserves and surplus?
No, not from the reserves and surplus, because what happens, our friend also said actually, he said because of deposit. So what he'll do, he would have deposited, or he would have taken borrowed. I mean, he would have given money to the bank, right? He would have deposited some money in the bank. So what happens? The bank will, they circle this amount. They circle this amount, whatever the money they have, they give it as a deposit for the customer. You get the interest. Suppose they give interest to him, 8% interest they give, and they charge 10% interest. So the 2% is profit for them, right? So that is what the normal business of the bank. So these two are, it is okay because it's going hand in hand, because it's two legs of any bank. But profit may not be, because profit is different actually. Profit also consists of various, other expenses also. Maybe, it is here it is.
So basically you're saying trend analysis is okay because you're checking the deposit and advances, and profit we are not looking that much into consideration in the actual practice.
Yeah, if you
example,
example. So if you see here, if it's 217 and the profit is let's say 280. See, this is 214, 217 and 280. So correct. Then there should be alarming factor actually. Something is gone good actually, because you're getting more profit. So we have to investigate why you have huge profit actually this year compared to last year. Okay. So that we have to understand.
For the loss also, right?
Same applies for the loss. So you have 214, here you have 217, here you have 180 or something, 180.
Okay.
So you can think last year also 180, 182, this year also 182, 180. So what is that? Still we are getting, you're getting advances and something is more, and whereas your profit is less.
Right.
Why? So you can also think about it could be a taxation issue. So last year it is only this much tax, this year it could be more tax or something like that. You never know. And this time they had many branches. They had mergers and acquisition. If you think about State Bank of India, they had many mergers and acquisition, wherein because of that they have to spend so much of money for various things like expenses for the salary expenses for the automation, other things. All this could be there. Right. So that we have to understand. Okay. So this is very,
Sir, I do have a question regarding the percentage which you are calculating. So, for example, now I'll take a profit for 1999 and 2000. So, ideally, it should be 4,06,287 minus 3,50,311. So, difference will be coming approx 56,000, and 56,000 divided by 4,06,287. So, it should come approx 12.5%. And so how exactly you are calculating? Because I had a doubt based on that, the percentage which you have written for
Okay.
each year.
Yeah. I'll clarify. See what I have done, this is the data actually. So we'll go to the first one. This is the data for me. So what I have done, I have taken 350.11 as 100 actually. So from here to here, what is the movement? I'm not talking about the change in the movement. I'm talking about the movement of, from here to here. What is the movement? So what I do, 406, I'm just taking that, movement actually. So I'm not taking that as initial actually. You got it? So I'm just taking this as a movement actually. From here to here, what is the change in the percentage? So if I take this as 100, so in your example, you're not taking this as 100 actually. In your example, what you have done, you're taken this 406 minus this, but you're not taking this as 100. So you are doing the trend analysis. You have to see the trend actually, right? So you have to make this as 0. You have to make this profit as 0. Profit as 100. So that is a base. From there, you have to calculate.
Okay.
Got it?
Yeah.
Okay. So the next one is, it is common size statement. So common size statement, I already discussed, example, the same balance sheet, what I've done, I've taken this as 100%. The total as 100%. So I have, what I've done, example, this. So what I've done, this divided by this, what is the percentage? This divided by this, what is the percentage? This divided by 472, what is the percentage? So it's kind of a ratio only actually. See, it's kind of an investment ratio to the to fixed asset. So same thing actually, but.
Sir, is it a general practice to take, so assume that I'm starting a company and the first year, should I take the initial one as 100%? Is that
You're talking about trend analysis or common size statement, madam?
In here also you've taken in common size statement also you've taken as 100%, right? And in
yes. Yeah, see, 100 is nothing but it's a 1 actually. What is 100%?
But my question is, when I'm starting a firm, is it a general practice I'm asking? Like when I want to compare with my next year. So it's a particular trend, right? So if for 5 years, if I'm running a firm, so from the first year, I always consider it as 100 or at any given point. Let's say I'm comparing two different companies. Let's say from 2010, I'm comparing. So the year 2010, I consider both as 100% when I want to do the trend analysis.
Yes. Otherwise, example, it's a very good question. So let's say that you also get ABC company, ABC bank, and this is ICICI bank, this HDFC bank. So in 1999, you have to take it as a base for both the companies. So then only you will get the trend analysis, right? Otherwise, you will not arrive at any conclusion. Okay, so whatever number you have in ICICI, we have to make it as 100. Then you keep on taking actually. So that is as Madam mentioned that the starting point should be always 100. Otherwise, we cannot draw any trend actually. Okay, so same thing actually. I give the example of sale. So you have January, February, March, April, May, June. So you have 1,200, 1,300. Example, January you have 1,200. February you have 1,100. 1,100. March you have something like 900. So what I do, so if I want to do the trend analysis, then I take this as a base. This is a base for me. This is 100. Then I have to see what is that change it as this divided by this, because I get a negative actually because it's gone down. Okay. So this 100.
Yeah, got it, Professor.
Yeah. So this is what we do normally. Okay. So wherever you consider, this is just a starting point. I don't say that no, you have to make it 100. I say that is a starting point. The starting point should always be, whenever you do a running race or something, the starting point should be 0, right? Then you start from there. Same thing here also. We take it as 100. If I want to say that no, this to this, what is the percentage of increase? I say 15% increase. From this year to this year. From this year to here, first year to this year, I can say 43% increase. If I say 99 as a base, I can say 43% increase. If I say if I sit in 2004, if I compare my profit to 1999, so I can say that no, it has gone up by 130%. So this 100, the 230 minus 100. So I can say it has gone up by 130%. Okay. So yeah.
I'm sorry, I just had one more question. Now, this is a incremental graph where we are having all the values. It will be a positive scenario, I'll say. But now in 2005, it got decrement to 2 lakhs. Okay, and if I compare with the 1999, what will be the value in that case? Because it will be 33%, what I'm assuming.
Okay, let's say that, no, for, I'll give the hypothetical example. Let's say it is 2005, right? Sorry, 205%. Are you getting it?
No, you can take the value as 2 lakh over there.
Oh, only 2 lakhs.
Yeah, 2 lakhs. Total value is 2 lakh now, because everything is incremental right now, and now it got decreased. So in that case, how it will work?
So in that case, it's going to be 350 divided by, sorry, so it should be 350, sorry, this should be 2 lakhs divided by 350 divided by, so your 350, so it is coming to 57%. So this is decreased actually, because why it is coming to 57? Because you set the benchmark as 100. So you are getting 2 lakhs. It is below 2 lakhs, right? So it is 57%. So are you getting it?
But it should be divided by 8 lakhs, right? Not 3 lakhs.
No, I'm not taking the incremental. I'm taking this as a base.
But okay. Okay, some confusion, because I was thinking
we'll do the same analysis here. Here, instead of 2 lakhs, I'll take 8 lakh 50, whatever, 806 something is there, right? It's coming to 30. Are you getting this? See, I am making this 99 as a benchmark. So from there, I'm not doing the incremental. I'm just comparing whatever numbers to 99 only. Okay, then I can see that what is happening here in the first year, that in the year 2000, it is 15% increase, and it is 43% increase and 50% increase. Then it is almost it is 50% increase. Are you getting the point?
Yeah, yes, sir.
Okay, so see, I'm not taking that here. I'm not taking year on year. Actually, this to this, this to this, this to this. I'm not comparing that way. I'm comparing this 99 to 2000, 99 to 2001, 99 to 2002, 99 to 2003. So that is what I'm comparing.
Yeah. Okay, sir.
Professor, I have a question. What we do generally is, in our sales organization, we always calculate either Y2Y growth or Q to Q growth. So in that case, we compare current quarter to previous quarter or current year to previous year.
Yeah.
So in that sense, we say either 2 or 3%. So previous year sales would be 100. Then we'll say 2% growth. It means that it is 102% growth.
Yes. So that is also correct. That's what I'm telling you. How you send the trend, that is what important. See, in this example, I've taken this as a base. So you can also take year on year. You can also say that. No, you can also see that. See, the same example. If you see the same example, if you take year on year, so that means year on year it is incremental actually. So what, sir, you are doing 100 and this one, it is incremental. That is 15 is increased. So this to this, it is almost it is somewhere close to 25%. This to this, so we get that trend actually. Then we can understand that if any year it is below the percentage, then we can start investigation. So see, this is what I'm telling you. This is trends, trend analysis. We have the trend. So we have to set the trend and we have to see the movement of this. So you can use that formula, as sir also mentioned that we can use that formula. You can use year on year, you can compare. Then it gives the same answer actually, same analysis, right?
Correct.
Yeah. So in the next one, I'm using a common size statement. So common size statement that I mentioned, that it's almost like a ratio analysis. So what I'm doing, I'm comparing total asset, I'm taking 100, and I'm dividing the same thing I'm doing actually. So this 5.73 means, so what is the percentage of cash to the total asset? That means I have in the total balance sheet or in the total asset, I have close to 5% is my cash, close to 2% is my cash with others, and close to 45% is my investment, and close to 41% is asset, advances. And if I see deposit is 85%. Okay, so that is the analysis we have to do that actually. So if you have the full data, we can do the analysis. So just this is an illustrative example that how you can do the analysis. Okay. So the next one is fund flow statement and cash flow statement. So I have taken the example of 2004 and 2005, and here I have the share capital, and share capital is increased. That means we got extra money from the shareholder, and profit and loss it is 3,000, loan is 10,000, creditors 18,000, bills payable 4,000, buildings it is same last year and this year is same. Plant and machinery it is decreased, it is increased. That means we paid some additional cash for 10,000 rupees we have paid, so that we have to take care. And stock we have and returns we have bills receivable and bills cash we have. So this is the balance sheet. So now we have to prepare cash flow statement. So fund flow statement. So what we have to do in the fund flow statement? First we have to prepare the schedule of changes in working capital. So what are the working capital here for me? So working capital in this case it is only these 3 or 4 items. So stock, debtor, bills receivable, and cash. So this will be my current assets, and these 2 will be my current liability. So this is what I have taken actually. So stock, debtor, receivable, cash, and I have taken creditors and bills payable. So the same thing I have put it here. So now I'm just seeing that what is that increase actually. So stock has increased by 5,000. So what is an interpretation I have? I'm talking about fund flow statement. So is it good sign or bad sign actually? Stock has increased by 5,000. That means we have spent money actually. 5,000 rupees is gone from the business. So that's what I have minused it. Okay, and debtors. So debtors last year it is 18,000. This year it is 28,000. That means I'm not getting that money from the debtors. That means it is getting accumulated. So because of which my cash flow is coming down. So what I do, I reduce 10,000. And next one, so bills receivable is last year it is 2,000, this year is 1,000. That means we received that 1,000 rupees. Okay, it's a good for it's an income for us, right? It's a cash for us, cash it's a fund for us. So what I do, I put it in plus. Next one, cash. So last year you have 5,000, this year you have 6,000 cash. So that means you're not spent that 1,000. So what I do, I minus it. So this is a simple rule actually. So what I do, increase in current assets. So what happens in increasing current assets? It's a negative actually. You always have a negative because increasing current assets. So you have stock. Example, this stock. So 20,000, it is 25,000. So that means you have paid extra money, or you have paid 5,000 extra from your cash. So that means it's a negative. And the next one, decrease in the current assets. So decrease in the current assets. So bills receivable last year is only 2,000. This year it is 1,000. That means we already collected 1,000 from the customer. So that's a good sign actually. So that's a positive one. So this is a golden rule actually for cash flow and fund flow. And next one is increase in the current liability. So what happens in the increase in the current liability? This is increasing actually. So that means we are not giving the money to the creditor. So last year it is 15,000. This year it is 18,000. That means 3,000 we have not given to the person. So that means we are getting that, we are retaining that 3,000 with our business. So it will be plus for me. And bills payable, you have last year 4,000. This year it is only this year it is 5,000. This year it is only 4,000. So that means we have paid in cash. That means cash has gone out of the business. So that is not a good sign. So I have put it as negative.
Sir, one question over here. Are we considering positive and negative only based on the values? So let's assume that bills receivable, we saw that, not bills receivable, sorry. Let's take on debitors. Okay, so we had in the previous year it was 18,000 and now it is 28,000. Maybe the company already, the debitors we already paid and it's a new debt, right? So in that case, are we not going to go and see the P&L and balance sheet?
No. We don't do that actually. We are just seeing that, see that is see what I'm talking about, not individual debtors. I'm talking about total debtors. Total debtors last year it is only 18,000. This year is increased to 28,000. That means we have not collected money for the extent of, see, I'm not talking about customer wise. I'm talking about value wise. So debtor, we are not collected to the extent of 10,000 compared to last year. So 10,000 is increased actually because 28,000 we didn't collect from the debtor. We are not collected from, we give the money, but we are not still collected the money. So I'm talking only in the fund flow and cash flow perspective. So that is not a good sign for me, right? You have the money with debtors, it is not a good sign actually. And vice versa with the creditors. So creditors, you have 15,000 last year. So that means this year it is 18,000. That means it's a good sign actually because you have not paid 3,000 to him. You have retained that money in your business. Right. The 3,000 is,
So
I don't.
We're not going to look on the further details, but we're going to see at the end of it what
yes,
how much money has come in and how much money has gone out, and based on that only we're going to do positive or negative, and not
yes,
based
yes,
on what happened behind it, right?
yeah,
That is,
yeah. This is only
I
for the, yeah, madam, this is only for the cash flow and fund flow statement.
okay.
Okay, what I do, I see that increment from the last year. That is the only thing I do. So this is schedule of changes in working capital. So this is if I do that, what is happening? So you have to remember this formula actually. This is very important. So increase in current asset negative, decrease in current asset positive, increase in current liability positive, decrease in current liability negative. So this is what you have to always remember this formula. So with that, what happens? If I just do the total of this, sum of this, I'm getting minus 13,000. Okay, so if I get minus 13,000, that means we have spent that money actually. It's not that we have already spent that money. So example, how you get positive negative? That means 18,000 and 28,000. That means we have given 10,000 compared to last year. We given 10,000 additional actually, whatever it is. So that is not a good sign for us. So if I take this total, so that means 13,000 will be your application of money. It's not a positive; it is a negative. So that means it is a money is gone from the business. So if I were to put that fund flow statement, let us assume that this is fund flow. So this is fund flow statement. So what is the source of fund for me here? So sources of fund. So share capital, is it source of fund for me? Yes, because last year it is only 10,000. This year it is last year it is only 1 lakh. This year it is 1,10,000. That means 10,000 has come to my business. That is my source of business. Okay, that is a source. And if I see loans, so yeah, if I see the loans, so last year I had only 20,000 loan, and this year, sorry, last year I didn't have any loan actually. This year I had 10,000 loan. That means the money has come to me actually. Money has come to me in the business. So I'll say loan 10,000. This is increment. Okay, then I'll take the profit. Compared to last year, 3,000 is my profit. Okay, here if I see 1 second. So this is schedule of changes in working capital, and this is what I'm doing the fund flow. So always you should have the sources and application of fund. So sources, you have share capital, you got 10,000 rupees from them. So this also 10,000 rupees. Okay, and profit you have 3,000 rupees. You have to say like compared to last year it is only 3,000. That is what positive sign. So that's what I have written. Then application of fund. So what is happening with application of fund now? So we'll not take think about okay, I mean current assets and current liability, because current assets and current liability, example, these numbers and these numbers we already taken actually. We already done the statement actually. We already done, and we say 13,000 is your net amount. Okay. So we already dealt with this amount actually. So we don't have to do with this, we already taken in your schedule of changes in working capital. Now what I have done, I have gone to the share capital and see what is the movement, whether it is a sources or it is an application actually. So if it is only 80,000 here, then it will be, that means, we would have repaid that, 20,000, then that will be application of fund. So it is source of fund actually. So I have taken 10,000. And loan, you don't have anything last year. This year you have loan. That means money has come into my business. So it is my source of fund. And profit also is compared to last year. Last year it is only 20,000. This year it is 23,000. I have taken 23,000 here. Then similarly, I don't want to do anything on this actually. I want to take only these two actually. So what happens to land and building? Nothing actually. Land and building is 0 because no increment value. So if I see plant and machinery, so plant and machinery, what is happening? Last year it is 35,000. This year it is 45,000. That means we have applied our fund actually to the extent of 10,000. We have applied the fund to the extent of 10,000. That means we have, money has gone to the extent of 10,000 from the business compared to last year. So then we also need to take this amount, because this is application of fund, because this is coming negative. So we have to take application of fund. So we'll take 13,000. So now So now both are matching. So from this, what we can understand, so from this, okay, from this what we can understand, so this is the business, and what we have sources. We got it from share capital, we got it from the loan, and we have the profit. And application, whatever money we got it, we applied only to your purchase of machinery. That is, we have spent 10,000. And what are the changes in working capital? So this is the effect of working capital. So that is coming as application of fund, but because I am getting 13,000 as negative, so I am putting it here, and my fund flow statement is matched. Any doubts in this, guys?
No, Professor, I think.
No.
All are good? Okay, so I'll tell you what is the purpose of doing this changes in working capital. So in I don't want to put everything here actually in your fund flow. I cannot put stock and all. It looks a little messy. What I've done, I've got this working capital. So working capital I have negative this time. That means we have application of fund. That is what interpretation I need to get. So this is what we prepare from the fund flow statement. Okay, so the next one we are talking about cash flow statement. So cash flow statement, it's a similar thing actually what we do for the cash flow statement, but we concentrate only on the cash. So in cash flow statement, there are two types of preparation of cash flow statement. One is direct method and one is indirect method. And both methods are, it is okay with all the accounting standard. But most of industry practice, they prefer to prepare cash flow statement in using indirect method. Okay, so indirect method, what happens is hello? Are you able to hear me?
Yes, sir.
Yes.
Yeah, sorry. Yeah, there was some kind of. So here, what is happening in? I was talking about fund flow and cash flow. So what happens in fund flow? Fund flow, we are not only taking cash, we are also taking other current assets. So that's what we have done actually. Schedule of changes in working capital. But in cash flow, what we do, we concentrate only on the cash flow. Cash. What is that? You have the beginning balance and you have the ending balance. And fund flow. You have direct method and indirect method. Indirect method, what we do, we start from the profit. Okay, so what we do, we start from the profit. What is the profit for the current year? Sorry. So what is the change in the profit for the current year? It is positive
3,000.
Yeah, it is profit. Okay, so now we'll go back to our this thing actually. So what happens to stock? I'll say stock. I'll say debtor. I'll say BR. I'll not take cash here because cash is that's what we are trying to calculate. And I'll say creditors. I'll say BP, bills payable. Okay. So what is happening with stock? So stock you're reduced by 5,000. Right. If I see the stock, compare this one and this one. So reduced by 5,000. That means your that means your stock has come down actually. Okay. That means you're not sold that particular stock and it is coming and sitting in your business. So that is not a good sign actually. Then debtor. So debtor, what happens? So you have paid compared to last year, you have paid more, 10,000.
10,000.
And if you see BR, bills receivable, it's a good actually because last year it is 2,000, this year it is 1,000. That means that 1,000 you already received from the bills receivable. And creditor, we'll go to creditors, 15 and 13. So increase by 3,000. Is it good sign or bad sign? Go to this one. Don't see this one. Go to this one. Increase in the current liability. Is it good sign or bad sign?
Positive sign.
It's a positive sign. So it is 3,000. And the last one is you have bills payable. That means last year is 4,000. This year is 1,000. That means we already received 1,000 from this bills payable. So this is done. So this will become cash outflow from, sorry. So this will become cash outflow from operating activities. Okay. So now what we'll do, as I mentioned, that we need to have the investing activity and finance activity. So if I go to investing activity, so what is that investment we have done actually? So investment will always be there in your asset side of the balance sheet. So do we have any investment for land and building? No, it is same actually. So we don't have to do anything. And plant and machinery, what has happened? We have done some investment. So that is negative actually. So that is negative. So what I'll do, I'll take that amount. 30. How much?
10,000.
10,000.
10,000. Yeah. So that is done actually. So we don't have to do anything on this. So I've taken out, see, this is consisting of everything actually we have taken. So this 10,000 will be your cash flow from investing activity. So I'll say cash flow from investing activity, it is minus 10,000. You agree with me?
Yep.
Okay. Next will be cash flow from investing finance activity. So finance activity, I told you about the liability side, any share capital, additional share capital, or any redemption, any loan, repayment, everything will be there in your finance activity. So number one, so you have the share capital. The share capital is increased actually. So 10,000 is a good sign. And the second one is loan. Loan, it is a good sign actually, 10,000. So then it will be sum of these two. So this is from the cash from finance activity. So if I take this 3, this plus this plus this, okay, I get 1,000. So to this you have to, I'll just place it somewhere. This one I'll put it. Okay, so this is balancing figure. To this, you have to add opening balance of cash. What is opening balance of cash? Opening balance of cash is 5,000. So I'll add 5,000. So this will be your closing balance. This plus this will be closing balance of cash. Okay, so this is what closing balance. So now you can understand the difference between these two, this and this. So this is more descriptive actually. It gives more detail about how you got the profit and how you got the opening, how you got the closing. So this is more detailed and elaborative. Actually, somebody asked me why we don't disclose fund flow. This is the reason actually. So both are almost same, but this is more micro level actually. You get more details of in case of cash flow statement. Whereas in fund flow statement, you get only the broader picture of working capital. So here you get what is the cash, and earlier it was last year it was 5,000, this year it is 6,000, and what is the profit, how the profit is reconciled. And one more thing, if there is a depreciation, you should add back here. You know why you should add back depreciation? Because depreciation is non-cash item. Okay, so what happens? You would have taken that in your profit and loss account. Okay, which the depreciation will not be having any impact on your cash. So what we do, if there is a depreciation in your this one problem, what we do, you say add depreciation and non-cash item, add depreciation and non-cash item. We do. In this example, we don't have depreciation. That is fine. So if there is a depreciation, you should add back the depreciation. Okay, clear, guys?
Yes, Professor.
Yeah, yes.
So you have, we have, we just discussed about, comparative statement, and we have trend analysis, and we discussed about common size statement, and we discussed about fund flow and cash flow. So I think, from this exercise, you can understand that front cash flow statement is more relevant and more elaborative. Actually, it gives details about each and every flow. I mean, both are same. I don't say that it is not different. It is same, but interpretation is different. You get more more interpretation from this. So you can say 9,000 is from activity. Minus 9,000 is from operating activity. That means you have outflow of cash of 9,000. And investing activity, you have outflow of 10,000. That means we purchased a land or we purchased a plant and machinery. And if you see finance activity, that means you have 20,000. That means we borrowed money from capital, or we also borrowed capital from the loan. So that is that is also showing. It's showing different activity: investing activity, operating activity, investing activity, and finance activity. So this is the bifurcation it's giving. So from this I can make out that we are not doing good in this one in terms of finance, and in terms of cash flow. This gives broader picture actually. What is that? How money is spent actually. Okay. So any questions, guys, so far?
No problems on this.
Sorry, ma'am.
Will we actually be solving more problems on this, or is it just like a part of the explanation?
You want to do more problems actually on this?
Maybe.
Yeah, you tell me. You tell me however you want to take it forward. I can take actually.
I think her question was like, is this problems part of our exams and things like that? I think so. Yeah.
Okay. So obviously, I think you guys. You were looking at what we discussed. Probably what I'll do, I'll share the same material to you. Okay. See what I've shown. If you see my balance sheet is very, very simple actually. You don't have any complication. So in your examination, you may have the complications. Yeah.
Okay. So basically, we have numericals.
You have numericals. So if you want, I can circulate that material. But for the sake of class, I just restrict myself to this problem. But I can give you more problems actually. I can share that material with you so that you can work out actually whenever you have time. And for the better understanding, you can work on this actually. I can give you that problems.
Yeah, Professor, that will be good.
Hey, this is just a miniature model. I don't say that it is a very nice problem. You'll understand everything. Just to understand the basics of this actually. See, the way I have written, this is not the way to write actually. This should be different, standard format. So for just to make you understand, I've just taken a very simple example. So probably what you can do, you can also take the financial statement of various companies. You try to, interpret actually. So how, things are working, you have to see that actually. You can also, think about it. Okay, how cash movement is happening. Okay, I think we are 12:40. I think I thought of completing ratio analysis. I think it's too much for you guys actually. So I think you had good patience and from morning. So what we'll do? I think we'll call it a day. And next class, what we can do, we can what I request before the class, I'll circulate the material with you, the question, so that we both can work simultaneously, so that you can also get proper understanding. Okay. From next class onwards, I'll give you the problems. I'll upload it in LMS. I don't know. I mean, what are the means actually? So I'll have it informed to you so that you can go and pick it from there, and we'll straight away solve the problem. You also can do. I can also do that. Okay.
Sure, sir.
Professor, we would require solution also.
Solution we are doing the class only, no?
No, means whatever examples you are sharing with us, no, sir, so that if we are practicing, we need.
Sure. Yeah, sure. So extra problem apart from what we discuss, whatever we discuss, outside this, I'll definitely share the material with you.
Sure.
With solution.
Yeah.
So this PPT and this problem will be there on the LMS or?
PPT and problem, yes. I'm planning to put in LMS.
Yeah, currently it is not there. I tried to.
Yes, it's not there, but because I prepared it only yesterday, So what I'll do, evening, I'll just check with, Mr. Arvind. I'll check, how we have to do that. And I also need to, give you the assignment today. So what I'll do, I'll just check with them, maybe tomorrow or, maybe, in a couple of days, I'll also give the assignment. So my assignment will be only on this, actually. Ratio analysis and, this one, that will be covering. Okay.
And Professor, even this recording, if you can get it uploaded.
Yeah, I think recording is already done in the cloud.
Yeah.
Okay.
Yeah.
Any reference books?
See, reference book, currently, I'll share that reference book. It's called Brigham, Brigham.
There's already one reference book that is uploaded on the portal, but then I guess that's just too much into detail.
Which one is it, ma'am?
I'll just let you know, 1 second.
Yeah.
It's a book on financial management.
Who's the author?
It's by T. Subramanian and Paramasivan, C. Paramasivan. The link is there in Moodle.
Okay, I have taken the same example from that book only. So I think, what you can do, problems, is very simple in Paramasivam. So I suggest you go to Brigham book actually. So what I'll do, I'll upload the Brigham book also, Brigham. So that is, international book. It's very good actually.
I think the example that you're showing was from that book, right, Professor?
Yes. It's from Brigham. Sorry, Paramasivam.
Okay.
Yeah. So what I'll do, I'll also kind of give you more kind of activities, so that it will be easy for you to commensurate whatever you have done. It is very easy to take actually, because the example is very simple. It is very simple and it's very nice actually. That's what I gave the example. So probably what we can do, I'll give you the problem actually from different sources, so that it will be easy and challenging for you to understand. For you to do that. Is that fine?
Yeah.
Sure. Okay. So I think you next class you have. What time you have the class?
1:30.
Oh, you have enough time. So that's what I didn't want to take your. I didn't want to kill your time actually, because it's a break time, so that you can go and have your lunch. So any questions, guys, so far? What we covered?
So just a general question, like related to AM, like how tough this subject will be and what is expected out of this?
What is it related to?
Like as in
accounting for managers.
Yeah, comparing with the accounts, is it some part theoretical in this, and is it the same way how we did in AM, or how exactly we are going to deal with this one?
How you did with, I don't know actually how you did with AM.
No, actually it was tough for us initially. So,
So what is your background, sir?
My background is engineering background. So
engineering. Okay, that's what maybe accounting. It could be little going above
most,
your head, because
most of us are not from the accounts background, so that is the reason.
I think that is what I need the basic. How the financial statement looks. That is what I wanted. Not more than that. I think when I discussed about different things actually, balance sheet. Were you able to understand that?
Yeah.
Yeah, that is what I wanted actually. So because that's what I mentioned, we're not preparing the accounts here actually. Accounts will be done by different team. As a finance manager, what you do, you interpret the numbers actually. So that's what you do. So you don't go in depth of debit, credit, and what is that, we don't do that actually here. So example, fund flow statement, what we do, plus minus, what is the interpretation, right? Whether current asset increasing, decreasing, that's what we do actually. If you know the basic concept of account, then it will be very easy.
Gotcha, sir. So the question was, I think he was asking or referring to us, how are we going to prepare for the exam? Means either it will be fully numerical problem in exam, or it will be subjective, means we have some question and answer so that we can write in theory.
Actually, it depends. Actually, question answers. Still, we're not come to the model. Why? Because because of the situation. Actually, will be more of aptitude question or case studies. But definitely, you'll be having at least 3 case studies.
Okay.
Yeah, and 3 case studies you'll have, and that's what I know actually. And you have multiple choice question, and the 3 case studies you'll have, and you will have 2 assignments.
Okay. So, sir, the multiple choice question would be a theory or numerical? Because in the last time when we are giving the exam for AM, so that also was means kind of a numerical based was there. So that is the reason we are asking.
Okay. See, to answer this, at least you need to know that, the formula. Example, I say, what is current ratio? I mean, the example I'm giving, this is, formula of current ratio. Current ratio is nothing but it is a current asset divided by current liability. So that numerical, at least, basic numerical we need. So I don't, see, you need, I mean, most of the people, they're all engineers. I think we'll play with numbers actually, but not with, more of accounting concepts.
Yeah.
Okay. So this, I mean, what we discussed about finance function, it's all, very much applicable for your organization, right? You have seen that, what is happening in the finance department. That's you would have seen, right? So, I mean, we are, that's what I asked you in the beginning. What is your, proficiency level in accountancy? So that is what, basic thing, what is balance sheet, what is your P&L account. That much is fine for me. So we don't have to do anything on that. So anywhere, whenever you see the balance sheet, at least you should know what are the components of balance sheet. Okay. So there are so many other topics, very, mergers, acquisition, and we have, amalgamation, and we have, holding company. So many things are there in accounting, goodwill valuation, all this. But we are not, dealing with that. We are focusing only on the financial statement interpretation, and we have little knowledge. We need to have little knowledge on accountancy. Okay.
Yes.
Yeah. So what I'll do, I'll just check with Arvind. I'll see that where I can upload, this one, and I'll also upload a few examples, that will be very easy for you. Then we can take it from there. And I'll also upload. You have any WhatsApp group or something for this? Okay. If you don't mind, you can include me. I can.
Santosh, I've added your number. I'm not sure if you've seen it.
No, did you add now?
3 days ago, because Rajan said he has passed on a number and he asked me to add you, and then I did that.
What is that caption you have? Because I have many groups.
Maybe I'll just ping you. I'll just say hi to you, and then I hope you've received my message now.
Yes.
Yeah. So then I think we should have only one common. I will also ping you the link.
No, I don't have that WhatsApp group. You ping me on.
I'll ping you the link to join, sir, so that you can,
yes. Yeah, we'll join. I think we'll make use of this. That link is not working
because you're already there in the group. It's called DSU EMBA Trimester 2. That's the group name that we have.
Okay, no problem. So I didn't I not pay attention for that. Okay. Thanks a lot, guys. It was really nice actually. So we'll kind of have the same interactive section next week also. So I think we can make use of it actually. So before the class, I'll give you the link. I'll give you the what is that I'm going to discuss in the class, so that it'll be easy for both of us to work together in the class. Yeah.
Santosh, can I just chip in, please?
Sorry.
This is Captain Nagaraj.
Sir, yes, sir.
So I see that 45 people are here. Hello.
Yes, sir. Yes, sir. I'm able to hear.
So I will request Professor Rajan or Malti to take attendance. Please keep an eye when you grade assignments, and class participation is important. Yeah. Can you hear me?
I can hear you, Captain.
Professor Santosh, can you hear me?
Yeah, yes, sir.
We could hear you, Captain.
Yeah. So if you find that people are not participating, they're not attending classes, you're free to act accordingly on the assignments.
Sure, sir. I'll do that. And morning we had 50 people. I think some people they got dropped. Just till now I could see 50 people in the participant list.
Yeah. So I don't run a correspondence course.
Okay.
So, folk, how are you doing? All good?
Good, sir. Thank you.
Good to hear you, Captain.
All good.
Yes, sir. All good.
Wonderful. Santosh, Professor Santosh is a outstanding professor, and I'm sure you will gain a lot of understanding from him.
Sure, Dean.
Sure, sir.
Very hands-on.
Absolutely.
Very hands-on. So I would encourage people to attend all his classes, please.
Sure, Dean.
Thank you.
Yes, sir.
Thank you.
Thank you.
Thank
So
you.
guys,
Thank you.
yeah. So yeah, we'll call it a day, and I think we'll correspond. We have the WhatsApp message. I think we'll kind of utilize it more efficiently. Okay.
Absolutely.
Sure.
Yeah. Thank you, guys. Enjoy your next session. That will be more interesting. Corporate law, and you have that corporate law, right? It's more interesting. One of
Thank
my
you,
interests.
Professor.
Thank
Yeah.
you.
Thank you.
Thank
Thank you.
you.
Yeah. Bye bye.
Thank you, Professor.
Bye.